The jobs market is showing that there's resiliency.
That's probably going to be the most critical piece of data that we're going to be looking for at that report is what happens with the average hourly wages.
If those wages tick up or stay sticky at 4%, then we'd have to adjust our expectations for the Fed.
There is more resiliency in the labor market. The economy continues to power forward.
This labor market, John, is just amazing. If we see a 213 or a 250, I wouldn't be surprised anywhere in between, which definitely demonstrates a very resilient labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. It is Payrolls Friday. Your estimate this morning, we're looking for a number in and around 200K. Pushing forward from yesterday, whipsawed. Absolutely massive reversal in this equity market on the S&P 500, Lisa. This equity market all over the place this week.
And it was incredibly confusing as to why. Some people sort of pointing to Neil Kashkari's comments about maybe no rate cut this year, but really people looking to the oil complex in particular. This idea that a sudden surge in oil prices takes the rally to something like 20% on WTI so far this year. And now it's for all the wrong reasons.
The commodity market is in the driving seat. Let's pull up crude and look at Brent and WTI. Brent crude back in the 90s. We're talking about new highs for the year. Brent crude $90 and about 84 cents. On WTI right now, 86.58. There is tension in the Middle East, a disagreement between the United States and Israel. And Anne-Marie, the prospect of direct confrontation between Israel and Iran.
And that's where we really saw the crude market move. It was coming after these comments Benjamin Netanyahu made after he came off this phone call with President Biden. And he said, whoever plans to harm us or does harm us, we will harm them. He was obviously, and he talked about this, was talking about Iran or Iranian proxies. And now you see some movements in Israeli communications, in Israeli GPS, that they are planning potentially for an attack. And that escalation, Jonathan and Lisa, is just going to breathe through the crude market.
You know, Stuart Kaiser over at Citigroup has been great on this. And he pointed to the fact that this really sets us up for a very wobbly response to any kind of surprise, whichever way, for the labor market report. He said, our view on Middle East risks has been that as long as oil prices were controlled, most investors would focus on other things. Crude now above $86 seems to be high enough to trigger that risk. So it seems like that's setting the backdrop for a bit of wobbles ahead of already questions around how much this Fed can cut.
Well, let's talk about the wobbles, Lisa, and push it through the Treasury market. Front end of the yield curve through the week has been really stable. All the action is at the long end of the curve. I think the low of the week is about 418. The high of the week on a 10-year is about 442. And the 10-year right now, where are we? 434. I talked about this market, the equity market being all over the place. Back end of the curve has been all over the place too.
And it's a confusing message. If you want to get on the bandwagon that the reason why the market is selling off because of the potential of no rate cuts, the Treasury market isn't cooperating that much with that view. If you want to take a look at oil prices, then it raises this question, is it disinflationary or is this just a risk-off knee-jerk reaction? You've been pointing to gold all week, and I'm glad that you have. Maybe that's the cleanest read on people who are trying to get ahead of central bank buying, who are trying to get ahead of a risk-off move that is a bit immunized from the bond market that's been really confusing.
Gold repeatedly over the last few weeks, all-time highs. If you are just joining us, welcome to the programme. Here's the price action for you on the S&P 500, attempting to bounce back from the biggest one-day loss since the middle of February. Equity futures positive by about 0.25%. Yields higher again, up and away this week by 3 basis points this morning, 433.75. And there's the moving crude, just inching higher today off the back of gains yesterday, 86.71 on WTI. Coming up this hour, Cameron Dawson of New Edge Wealth as crude breaks through 90. Ed Mills of Raymond James as President Biden takes on Netanyahu. And Sarah House of Wells Fargo as we count you down to US payrolls. We begin with our top story. Global stocks selling off ahead of the week's main event, the US payrolls report. Cameron Dawson of New Edge Wealth watching wages and the rising cost of crude, saying this: if wages moderate further and we continue to see gasoline prices rise, could we see a reversal of the recent improvement in real income growth, which would weigh on consumer sentiment? Cameron, I'm pleased to say, is with us around the table. Cameron, when we think about what's in the driving seat, good morning to you, is the commodity market in the driving seat, cross-asset right now?
I think it's incredibly important because the Fed can't ignore that. We think the Fed is still kind of living in the second half of 2023 in this world of immaculate disinflation where crude prices were falling and it looked like we were on this path towards 2%. They've been ignoring the messages from commodities, we think, year to date, meaning that you've seen this big jump in gasoline prices, you've seen this big jump in gold, copper, as well as inflation break-evens. We don't think that they can continue to ignore that, meaning that if we see inflation move higher, it really calls into question Powell's willingness to say rate cuts still are coming.
So far, whenever they're asked about it, Powell in particular, will say, this is just one aspect. We don't really have any control over the oil market. We don't have the control over commodities. We'll put that aside. What is their response to higher commodity prices if it dents consumer spending and potentially acts disinflationary as a disinflationary force?
Eventually, the challenge with higher commodity prices is that, yes, they're exogenous. They're something the Fed can't control. However, it's when they become endogenous. They get proliferated through the entire economy when you have a challenge. The thing that we think to watch is forecasts for household consumption. They've gone up significantly over the last 6 months. They're now at 2% growth for 2024, up from just above 1% a few months ago. If you have oil prices continue to move higher, that could pinch consumer spending. Household consumption rolls over. That's 70% of GDP. GDP forecasts roll over, and that's when you would see a broader risk-off move. It's something to watch.
But we've only seen oil really break out because there's geopolitical risk. So do you think potentially this is just temporary and it's actually not supply and demand of the market?
It is also very interesting in the context of a strong dollar, right? We usually expect to see oil be much weaker when the dollar is weaker. However, now that you have a strong dollar at the same time with higher oil prices, it speaks to supply and demand. Maybe there is also some sniffing out the fact that we are starting to see a cyclical manufacturing recovery, not just in the U.S., but globally. You're seeing a little bit better activity out of China. Look at South Korea exports. Look at Japanese machine tool orders. They all suggest a global manufacturing recovery, which would be bullish for oil demand.
Saw the same in the US on Monday. That really got this market move going. Let's talk about treasuries. Your words. Broke above an important resistance of 433. If this holds, the 10-year could make a run for 450 to 475 on the back of higher growth, higher inflation, more treasury supply. Where are we right now? Just above 433. Why is that level so important?
It's important because it's the prior resistance from highs earlier in the year. We also saw that be a resistance level back in late 2023. So if we break through that, we think much higher yields would certainly be in play because then you would have short covering, et cetera. So we think that it is a potential in something that people aren't positioned for. And the equity market also isn't positioned for, which just means that there's a lot of expectation that yields will fall, the Fed will cut rates, and that we'll have this sigh of relief on balance sheets. If that doesn't happen, some of your riskier, low-quality equities likely begin to struggle.
So equities didn't struggle through the first quarter of the year, even with the rise in yields. What's different about this setup?
We think the reason why equities didn't struggle is because growth forecasts went up so much. You added 100 basis points to GDP forecasts over the first 3 months of the year. Equities love that. That's also why credit spreads are so tight. If you have questions that could start to move in the other direction, then yields become an issue for equities because you don't have that boost from growth.
We talked about the idea of Goldilocks and sort of this question about how long that can continue. Julian Emmanuel of Evercore ISI basically said, the Goldilocks narrative is under pressure in a pretty significant way. Are you seeing signs that it's significantly deteriorating, that the knee-jerk response is no longer going to be higher yields, just means stronger growth, and that is good for stocks? Have we reached that tipping point?
I think we have to take the message from stocks itself, which is that we are still technically in an uptrend. And if we start to break some support levels, that's when you would start to look under the surface and say maybe there is more of a growth story at play. Breadth has gotten a lot better within markets. We've had a lot more participation. However, tech, which is a large weighting within this market, very important, has seen breadth deteriorate. So if tech goes from just lagging to being outright weak, that's when we could see a bigger issue for the market.
Well, that's where I wanted to go. Yesterday's action was really confusing for me. I was looking at what outperformed. The tech names underperformed. The NASDAQ was underperforming. The Russell 2000 lost less. I don't want to say did better. Did you take anything from that, and how much that people really want to broaden out their exposure, sell what they can in bad times, and buy the riskier segments in the good times?
Yeah, industrials outperformed, energy, materials, even some of the financials, which is this cyclical value trade, which brings us back to the manufacturing recovery, which could be the area where you see the most potential for upside to earnings growth forecasts. You've already re-rated the tech sector. It's extraordinarily crowded. It's had $60 billion of inflows. Every other sector, outflows. So it's high valuation, very crowded, which just means it's a high bar for upside surprise, which is probably why we're seeing this rotation under the surface.
Lisa talked about this a few times this week. High yields, high crude prices. Does that encourage the rotation or derail it? Which one?
It encourages it initially because you do know that you have this relationship between higher commodity prices and those cyclical value sectors. The problem is that if those higher commodity prices get you back to cutting growth forecasts, that's when you start to see cyclical values start to stumble.
So energy stocks over, say, small caps right now, with that in mind? Would that make sense?
Yeah, and we think you can find great high-quality energy names that don't have bad balance sheets, that benefit from higher commodity prices, that you're not having to take a big risk-on approach. You're just saying that, hey, if energy prices go up, a lot of that falls down to the bottom line. They'll buy back a lot of shares, and that's good for the equity.
We're 2 hours and 20 minutes away from non-farm payrolls. This was supposed to be the main event of the week. Right now, it seems like noise, and everyone's just watching what's going on with the price of oil. What are you looking for, and how vulnerable is this market heading into this print, given just how wobbly things have been over the past 24 hours?
Yeah, a hot print likely would push that upward pressure on yields, but then you might say, okay, earnings and growth can hold up better. We still think that bad news is bad news for this equity market. A soft print means that growth forecasts are too high, and that all of us pricing out a soft or pricing out a hard landing, and you have everybody on the boat of no landing, soft landing. Does that challenge that narrative, and you start to see growth forecasts fall?
Just quickly, is good news good news? And what is good news today?
I think good news is good news eventually. The initial reaction might be negative simply because of that yield pop. But if you continue to see resilient data that supports growth forecasts, it supports credit spreads, which means that eventually good news is good news.
Let's clear that up, Bramo. We always do. Every payroll's Friday.
I would just like to say then, if bad news is bad news and good news may eventually be good news, is good news bad news and bad news bad news? Have we moved away from and reversed the kind of good news is good news and bad news is good news? I'm losing myself.
I think I caught up. I think I'm up to speed.
Thanks, I appreciate
Bramo,
that.
thank you. And Cameron, thank you.
Thank you.
Jobs report, 2 hours, 18 minutes away. 214,000 is the estimate. The previous number, 275. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Heques. Hey, Yahara.
Hi, John. Argentina's President Javier Milei has told Bloomberg he won't change the existing trade and financial ties his country has with China. It's a marked change in tone for the libertarian leader, who had previously likened Beijing to an assassin. Editor-in-chief John Micklethwait asked him if he still stood by those comments.
As for the Chinese government, what we've always said is that we are libertarians. And if people want to do business with China, they can carry on business as usual. What I said was that I wouldn't be aligning with communists.
President Milei added he had no intention of touching the $18 billion currency swap between the two countries. Samsung sales missed forecasts in the first quarter, but preliminary operating profit rose, ending a string of quarterly declines for the company. The results underscore how demand for memory chips that power electronics are starting to rebound after a severe downturn in the industry. Plus, the Wall Street Journal reporting Samsung plans to raise chip investments in Texas to the tune of $44 billion. And mortgage rates rose in the U.S., but just by slightly. Freddie Mac says the average rate on a 30-year fixed loan was 6.82%. That's up from 6.79% last week. Freddie Mac's chief economist weighing in, saying, while incoming economic data indicate lower inflation, they don't expect rates will come down meaningfully in the near term. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. I wish you could see Bramo's face every single time anyone reads anything about mortgages. Just this little sort of smug grin.
I knew you were going to.
I saw that out the corner of my eye.
No, I was actually thinking about all the people who come on the show and say, I remember when mortgage rates were 20% and everything was just fine. Exactly. Yeah. So I was thinking about that conversation, affordability issues. I wasn't thinking
Of course.
Smug.
Thinking about the small people out there, like us, who rent in Manhattan. This from Michael Hartnett this morning at Bank of America. Zeitgeist, they just jacked up my rent 20%. I'll have to move again. From a colleague in New York City. I think a lot of people feel that pain.
And there's a sense that there isn't necessarily a clear relief because guess what? It's hard to buy right now. That's what I hear.
In a big way. So we're sort of waiting for rate cuts and then you can get the supply on the market. And
then prices might go down. That was
something like that. That's so I'm told. I think that's what we're all hoping for. Whether that happens is another thing altogether. Up next on this program, escalating tensions in the Middle East.
I think there's a long tradition of the American-Israeli alliance. It's always been necessary, but it's more necessary now. This is a battle between not only Israel and Hamas, but I would say the axis of Iran.
That conversation up next, live from New York City this morning. Good morning. Payrolls Friday. Here are the scores for you on the S&P 500 equity futures right now, just about positive by 0.25%. Yields bleeding higher again by 2 or 3 basis points, 4.3335. All eyes on crude. WTI 86.75. Brent crude in the 90s. This morning on Brent, $90.99. Under surveillance this morning, escalating tensions in the Middle East.
I think there's a long tradition of the American-Israeli alliance. It's always been necessary, but it's more necessary now. This is a battle between not only Israel and Hamas, but I would say the axis of Iran, the terror axis of Iran that seeks to put the Middle East back into the dark ages.
Here's the latest this morning. Israeli Prime Minister Benjamin Netanyahu preparing for possible retaliation from Iran as the risks of a direct conflict rise. Meanwhile, President Biden is calling for an immediate ceasefire in Gaza after a direct conversation with Netanyahu. Ed Mills of Raymond James writing this: the pressure is building on Speaker Johnson to bring up the Senate-passed defense supplemental. Expect pressure to build on the bill if we see an expanded Middle East conflict, which has markets on edge. Ed's with us right now. So, Ed, talk to us about the possibility of an expanded Middle East conflict.
Yeah, so what I'm looking at here, and Prime Minister Netanyahu is right, but this is a both and. The Biden administration is absolutely in support of Israel and its right to defend itself, but they are not necessarily in support of Prime Minister Netanyahu. So when we look at it from the U.S. lens, we have this long-delayed defense supplemental. When Congress returns next week, this is the first time since September where they're in D.C. without a looming fiscal cliff. The government's not going to shut down. There's time to do other things. So the pressure is building on Speaker Johnson to get something done. Our expectation is absolutely something is going to get done. Probably not next week. It probably goes a week later. But in D.C., whenever there is an increasing crisis, there is an increasing pressure on Congress to deliver. So if we do have an increase in these tensions over the next couple of days or next week, that's where the real pressure comes on the House to pass this bill to make sure our allies have the resources they need to defend themselves.
But Ed, Secretary Blinken had even sharper language than President Biden. He said if we don't see the changes that we need to see, he's talking about Gaza, there'll be changes in our own policy. How much more difficult is it to then pass this bill in the House when basically the administration is putting conditions on aid for Israel?
Well, Annmarie, it is not just Israel. It's also aid for Ukraine, support for Taiwan. But what we have seen is this desire to make sure that the allies of the United States have the resources that they need. And this package is absolutely needed. It absolutely complicates things. We have domestic political considerations to deal with here. Speaker Johnson is facing pressure from his right flank with a possible motion to vacate and kick him out. So there's never a straight line in U.S. politics. But if there is a broadening out of this conflict, and there is a real sense that the aid is absolutely needed now, that could be the catalyst to get this across the finish line with some changes, probably with some conditions. If the House changes this bill, then it has to go back to the Senate. And you see some senators, especially on the Democratic side, who have supported this aid, who will want to make sure those provisions are added. So I think the Biden administration is trying to preempt that, making sure that this aid can get passed and delivered in a way in which we support Israel, but maybe not support the political infrastructure within their government.
I'm really unclear, Ed, on just how much this administration's approach has shifted around Israel, because we have heard this rhetoric harden over the past few weeks, and yet lots of weapons continue to flow, and there still is this sort of feeling that there needs to be more done by the U.S. to support Israel. How significant is the shift?
I think the shift is largely dealing with the facts on the ground and also the political implications here. When we look at polling data, the three things that are really drags on President Biden: inflation, the border, and geopolitical unrest. if we have a widening out of this conflict, if things continue to have humanitarian crises within Gaza, those are really hard things for the president to win re-election with, especially among poor portions of his base. And so with the death of the 7 members of the World Central Kitchen, that crystallizes things for a lot of folks, especially in D.C., where that was started to push this towards a solution that allows them to deal with their military needs, but also recognizing a real humanitarian issue.
I'll be slightly more blunt, Ed. The civilian death toll is absolutely tragic, and I just wonder if the messaging yesterday was for Netanyahu or for the people of Michigan. Which one was it?
I think it's both. I mean, I think that we are working with a lot of both ends. If President Biden does not win the state of Michigan, he is unlikely to be president next year. The humanitarian toll here is also catastrophic. And the more that this is pursued without what the Biden administration has been pushing for months now, which is some more humanitarian relief, some level of a ceasefire within Gaza, if they're not able to get the government on board with their actions, they're not going to be willing to have an open-ended commitment. And when we're having this aid package sitting there, ready to be delivered, that is a crucial point at which the Biden administration can force some of these conditions. So they're using that leverage.
Ed, we'd love your thoughts as well on the tension between the US and China. Strong words from Secretary Yellen overnight. China has pursued unfair economic practices, including imposing barriers to access for foreign firms, taking coercive actions against American companies. Ed, that's been a story for the last 2 decades. I just wonder what they can do about changing that anytime soon.
John, I think the T word is going to be back. We're going to be talking about tariffs sooner rather than later. What we've heard is that the Biden administration was really close to a tariff package at the end of the year. I think this is the signal from the Biden administration a new tariff package is coming. That tariff package is going to increase certain tariffs like EVs, semiconductors, solar, but decrease tariffs on a lot of consumer goods, which would be an inflation reduction package for the American people. As I talked about, inflation, a really important issue for President Biden. And this will juxtapose the tariff message coming from the other T, President Trump, who seems to want to have across the board. So having a debate over how to do tariffs versus some of the inflationary concerns of that 10, 60, 100, 200% tariffs that former President Trump has talked about. That's the signal I get from this conversation overnight from Janet Yellen.
Ed, so if they bring up those tariffs, is this another form of messaging ahead of the election when it comes to China?
It is both messaging and it is national security driven. As I look at EVs, semiconductors, solar, those are areas within the Inflation Reduction Act where the United States is building capacity here in the United States. We can't build capacity here and have China flood the market and undercut that because we are doing that for national security purposes. And if we can have inflation relief on some consumer goods, so when you go to your store and if there's something made in China, it doesn't have that 25% tariff, you can see actual relief in pricing. That has a benefit for the consumer. I do think you actually will see things that will be impactful before folks go to the polls here in November, where they will see it. And on semiconductors, we've had tariffs, and what we've seen is a significant drop, a 47% drop in semiconductors from China, but only about a 4% increase in the cost of those semiconductors. So they'll point to that as tariff policy that actually works.
Interesting. Ed, thank you. Always appreciate your insight. Ed Mills there of Raymond James on potentially the warm-up act in China taking place before the big policy shift.
All I can say is that Michigan is so much front and center in our geopolitical discussion. And
Both stories.
Both stories. It's just sort of amazing to see how Michigan's at the epicenter of geopolitics right now.
We'll talk about Michigan again in just a moment. Bloomberg's Craig Trudell as Ford bets big on hybrids. That conversation up next. Live from New York City this morning. Payrolls just around a corner. This is Bloomberg. Equity futures right now trying to bounce about 0.25% on the S&P 500, heading towards potentially the biggest weekly loss of the year so far. We're down about 2% at the moment. We're positive a third of 1% on the Nasdaq, absolutely whipsawed by what's happening cross-asset, including bonds and commodities. So let's start with fixed income and turn to treasuries. The 2-year, interestingly, has been really stable through the week, still in and around 465, 465.83. The 10-year has been on quite a ride, and we'll catch up with Priya Misra of JP Morgan later about this. But at the low, a break of 420, sub 420 at the high, north of 440, all in a couple of days, Lisa.
And it has a lot to do with the conviction that market participants have that the Federal Reserve is going to remain restrictive long enough to keep inflation under control longer term. We started to see that get a little unmoored yesterday. Neil Kashkari of the Minneapolis Fed coming out saying, we might not cut rates at all this year. Not sure how much that was market moving, but it just infected the feeling that had already kind of percolated out through the week.
Crude infecting everything, and you could really feel that in yesterday's session. So let's switch up the board and turn to Brent and WTI. Brent crude at the moment, very close to 91, breaching that level earlier in the session, positive a third of 1%. WTI 86.75. Those comments from Netanyahu yesterday on Iran, and I think all this week over the last few days, the risk of direct conflict, a broader regional escalation really feeding into higher crude prices through the week.
Absolutely, and that is why everyone's very concerned. And you just saw Brent crude there now, $91 a barrel. It comes on two of these comments. One, Biden basically saying that what happens in Israel, there's going to be conditions on. They're determined by their assessment on how much they support Israel, on how much Israel is going to deal with civilians, humanitarian aid. But then Netanyahu basically saying, we will hit back and potentially we will preempt any strike that we're prepared for.
Brent crude back through 91 as we speak. Under surveillance this morning, it is payrolls Friday. The report about 2 hours away. Bloomberg survey calling for a print of 214,000. And for average hourly earnings to rise 0.3% month over month. Morgan Stanley leading estimates on Wall Street expecting 245,000 jobs. Citi on the other end seeing 150K. And Citi is the interesting one for me. Andrew Hollenhorst looking for real weakness in this labour market, triggering more than 100 basis points of cuts this year.
And they've been on the bandwagon that the Fed wasn't going to cut until June, way before everybody else. So it's a really notable call considering the fact that they weren't exactly on the leading edge of the rate cutting discussion. Here's my issue, and this is something that Cameron said earlier, which is bad news is bad news. And I wonder if good news is bad news, too. I wonder if the market right now is set up to see any surprise in this labor market print as something that could potentially unravel a Goldilocks-type feel that already is being so deeply challenged at a time where there are higher oil prices and there are some potential challenges.
I just wonder how much weakness needs to be in the labor market if the Fed was to come in and really put June as pretty much with conviction that it's going to be a June cut. Is it a 2? Does it need to be below a 2 handle when it comes to the labor market?
Lisa mentioned Neil Kashkari. Let's get to the quote. In March, I jotted down 2 rate cuts. If we continue to see inflation moving sideways, then that would make me question whether we needed to do those cuts at all. How lonely is Kashkari is a question we've asked through the week. How lonely is Bostic? How much company do they have on the FOMC?
We did hear from some others. I can tell you Austin Goolsbee firmly not enjoying lunch with them at all. We heard from him that basically, I think if you take a longer arc, inflation's coming down and we're going to get to 2%. He's the resident dove. He wants to cut rates. He's been very clear about that. Loretta Bester, a little different. She basically said she needs a couple more months. This is really the issue and the reason why actually the next couple of months of data are that much more important, because they need to see evidence that inflation is coming down for the majority of the FOMC to get on board with this idea that June really is the time.
I still sense the grand compromise, and it could change with the incoming information, could be June cut, dot shift from 3 to 2. I think that's how you get everyone on the same page at the moment.
Yeah, although, again, we've just seen how much the economic data has moved past them and moved quickly. And that's why Andrew Hollenhorst's call, as you mentioned, was so interesting. He was saying, yes, maybe we've seen upside surprises, but those downside surprises are going to begin and then they're going to escalate on themselves.
Citi looking for 150 a little bit later this morning. We'll continue to go through the numbers for you. I want to turn to this story. Strong comments from Treasury Secretary Janet Yellen taking on China, accusing the country of coercive actions against American companies. Yellen saying she intends to keep bringing up the issue as her trip continues over the coming days. The Biden administration is ramping up criticism of China's subsidies and manufacturing ahead of the US election. Biden and Xi speaking for the first time this week since meeting in California last November. We just spoke to Ed Mills about 10 minutes ago. Ed gave me the impression, he alluded to this, I think it was pretty direct in fact, that this feels like the warm-up act before a big policy shift on tariffs.
Yeah, it almost feels like she's going to Beijing, and right now she's in the province that actually, what I think is interesting, is the home to Huawei and BYD, this massive export hub that gets to the fact and the tension between Washington and Beijing. She's almost there to warn them that these tariffs are coming, because she has been saying this now for the past week, and she says she's going to continue to save it. And before she made these comments, she sat down with Western businesses, European, Japanese, American businesses. So they're taking a very multilateral approach. It's not just us who feels this way, it's the rest of the world.
There was a great Wall Street Journal story overnight that talked about the China Shock 2.0 and how China is preparing to just unleash another flood of cheap goods on the world. And how if the U.S. closes its borders, well, those goods are going to be unleashed on everyone else, which is the reason why this is multilaterally and the reason why this is such a market-moving kind of event. How long can everyone keep building bridges to nowhere? How long can everyone keep building goods that there isn't necessarily all the demand to suck up? And that really is one of the key questions between whether inflation will be higher or whether it will be lower because of all of the supply coming
Politically speaking, is that the wrong kind of disinflation going into November?
Probably. That's basically what Janet Yellen said. She said that the idea of something being on sale, she used to say thank you. Now she says no thanks.
It's quite a change for Janet Yellen, isn't it? What a journey over the last 20 years from economist to politician. It's quite a round trip.
It's quite a round trip for all globalists right now who are dealing with the aftermath of sectors of the U.S. economy that have been blown out and that haven't recovered. Enter Michigan.
It's a huge shift from her when she entered the Treasury Department. She was one of the few, I think, around the table that even when inflation was higher would potentially say, well, we should maybe look at the tariffs. She moved towards the Jake Sullivans of the world.
I just read comments like this and I think, where have you been? Where have you been? For everyone who talks this way, says things like unfair practices. It's been a story for ages. When you hear things like imposing barriers to access for foreign firms, go speak to tech firms on the West Coast for much of the last decade. When you hear things like taking coercive actions against American companies, seen that repeatedly, time and time again. The question that I would ask is, what took so long? Why did it take the election of Donald Trump in 2016 to really make this the consensus position down in Washington, D.C.?
It's a great question. And whether or not lines have gotten harder or whether it's sort of the reality meeting the sort of academic idealism that a lot of people had when they worked on policies from sort of the ivory towers versus going out and seeing the practical effects and the lack of offsets that so many countries have had to really make things better for people who are buying cheap goods but unemployed.
EVs are at the heart of a lot of this right now, and Ford is making a shift away from EVs, announcing it will offer hybrid versions of all of its models by the end of the decade. The company saying hybrid sales jumped 42% in the first quarter, helping to boost sales overall. Bloomberg's Craig Trudell joins us now for more. Craig, let's talk about this. How much of a change is it for Ford, and how long before I start to see headlines crossing a Bloomberg terminal from GM?
No, I think it's really an interesting move, and I should give a shout out to our very own Keith Naughton in the Detroit Bureau, because he reported in Business Week a few weeks back that Ford was going to make this move, that they were going to push back the introduction of a 3-row electric SUV. The plan was to put that into production next year, and that'll get pushed back to 2027. I think they've also just talked a lot about the demand that they've seen for hybrids. The F-150 hybrid that has been in the market for some time, just the dramatic increase in sales that they've seen. The first quarter, those sales were really what sort of drove the increase for the company. And we did hear from Mary Barra earlier this year that she too will pivot a little bit and make more of an investment in hybrids. And that was a big departure from the message out of GM. For some time, they had really been talking about, all electric. They had the tagline of, everybody in, really pushed for, fully electric vehicles, and found that, one, they were having trouble making them, and two, that on the other side, the consumer was not necessarily interested. There was interest a few years ago in Teslas, and that, sort of led the rest of the industry to say, we better, get there fast. I think once they arrived, they realized that the demand had really been sort of met to some degree, and they've really had a hard time competing with Tesla.
Craig, I'd love your comments on what we just heard from Ed Mills, this idea that the U.S. is preparing for a new round of tariffs and a real policy shift with China. Do you think that Ford would welcome additional tariffs on incoming cars, in particular electric vehicles from China, or does it not really matter because they're moving away from that anyway?
I think it's interesting because, Trump already took tariffs, pretty high on Chinese vehicles. There is talk now under the Biden administration of taking those even higher. I don't know that it necessarily is going to make a whole lot of difference in the sense that the Chinese manufacturers, even the likes of BYD, which has just been on fire the last couple of years, they've really sort of viewed the U.S. as off limits. And maybe there's some attempt down the road to enter the U.S. through the back door of building a plant in Mexico and bringing EVs in that way. And there's definitely, I think, already some looking at that on the part of the administration to try and, guard against that possibility. I certainly think Ford would rather not have to compete with BYD in the U.S., but I also sort of doubt that they really see that as a high likelihood, given the stance that Washington has taken on China and just how much everybody's sort of racing to be, anti-China in D.C. and protect American jobs.
Craig, we recently spoke to the Nissan America chairperson who said the administration blew it. Do you think what we're seeing from Ford, the push now into hybrids, would have happened sooner if the administration didn't have this massive push into electric vehicles?
It's a good question. I do think that this is in some ways enabled by the administration pushing for a localized, battery industry. And even if we don't go fully electric, if we have batteries to supply to hybrid vehicles, it is not, sort of a loss for the administration or for the U.S. auto industry. It does mean sort of more incremental progress. And we, of course, would love to see the world jump to cleaner cars. But if we are in a position where, the consumer just isn't there yet and more work needs to be done to bring them, over the line, I think it's just a matter of sort of coming to grips with reality. But I also think it's just a really complicated and difficult thing to do here to get the American car buyer, to make that jump and get the industry to come along for the ride as well. You have Toyota, the sort of hybrid leader that's been, really the loudest voice critical of this administration and their policies to try and get the industry to go fully electric. They've really dragged their feet over this.
And they're dominating, Craig. That's the point, because that's where the market is right now. Yeah. Speaking of getting to grips with reality, I think it's really difficult to do in the auto market at the moment. When you say things like clean cars, I think we're talking almost exclusively about zero tailpipe emissions. But Craig, I'm yet to be convinced that the development of some of these large SUVs in Detroit, in Michigan and elsewhere in the United States of America with these giant batteries that are manufactured with pieces coming all around the world and natural resources out of China are actually clean cars. Have we settled that debate?
Well, I think we absolutely have settled it. And you're right. I am referring to, from the tailpipe. And really from a matter of, on the front end, the emissions of making an electric vehicle are higher than a gas vehicle. But over their life cycle, I think Bloomberg New Energy Finance just recently has looked anew at this. And, virtually everyone who's crunched the numbers about life cycle emissions finds significantly less emissions for electric vehicles than combustion cars. I do think the point you make here is really interesting. The idea of this full-size SUV or three-row SUV that's been delayed, it makes a lot of sense in that, we've seen Ford sort of, front-load its investments in electric vehicles in these big pickups and in these big SUVs. And they kind of, came to a realization of, wait a minute, we're putting these big batteries in. You need more battery to move more weight, to move bigger structures. That means more costs. That means, less attractive to the consumer. What are we doing here? And they have sort of had this rethink of, we need to go with smaller silhouettes, invest in some of the, smaller SUVs, maybe even cars, which they did away with years ago. But I do think it's really interesting that we've seen such dramatic strategy changes, whether you want to talk about Ford or GM. Yeah. It really speaks to just how complicated and costly this transition has been for the industry.
We appreciate your clarity. It's been amazing to follow this story with your help, Craig. Thank you, sir. Craig Trudell of Bloomberg. This market is in a very different place. It's pro-hybrids right now in a big way.
That's where the demand is, and arguably that's also potentially all in from ground to product, the cleanest for the United States. What strikes me is how much it's becoming clear that the Chinese EV policy is very different and driven by different motivations than the U.S. EV policy, and how it doesn't necessarily cohere in terms of how successful both can be at their aims.
If you're just joining us, welcome to the programme. Equity futures positive by about 1/3 on the S&P 500. The jobs number a few hours away. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Bank of Japan has signaled it may hike interest rates again this year. BOJ Governor Ueda saying in an interview that the bank's inflation target will become increasingly likely to attain through the rest of the year. The remarks suggesting the BOJ wants to confirm the spread of wage gains and their impact on services prices before raising rates again. Ueda reiterated that the bank will respond to foreign exchange movements if they affect the wage and price growth. A United Airlines flight crew is being investigated after a plane slid off the runway in Houston last month. A preliminary report from the NTSB saying the plane's captain appeared to stray from United's procedures for landing in slippery conditions. The 61-year-old captain told investigators the runway appeared dry, but his co-pilot thought it looked wet. The incident marking the latest in a series of recent issues for United and the Boeing 737 MAX aircraft. And Apple has laid off more than 600 employees after scrapping its projects for a car and a new smartwatch display. According to filings, the tech giant winding down both initiatives at the end of February, with more than 350 workers released from the company's main car-related offices in Santa Clara, California. The car project was canceled amid indecision among executives about its direction and cost concerns. That's your Bloomberg Brief. John?
Yahara, thank you. I hate doing this as people might be heading to the airport, but does air traffic control not tell them if the runway's wet or dry?
Why is that in the story? That one thought that it was wet, one thought that it was dry. Why are we knowing about that? I don't want to know about a disagreement in the cockpit about whether the runway.
Are they eyeballing this on the way down?
Exactly.
But there are people on the tarmac. How do they not know if it's dry or wet?
This is not a debate that I want to ever hear about again. Whether two people are saying, you think it's wet?
It's like the more you find out, the more shocking it is.
Exactly.
Right?
I think it's dry. Keep going.
All this time, I didn't realise they were eyeballing the runway on the way down.
I think I got it.
Is it dry? Is it wet?
I think it's good.
I'm going to leave that story there. Up next on this programme, jobs data on deck.
That's going to be a report that says the economy is still strong, but it's not something that gives a definitive signal to the Fed that they need to cut very soon here.
That conversation up next. Equities right now bouncing by 0.25% on the S&P 500 following the biggest one-day loss since the middle of February. Yields higher by 2 basis points. The 10-year 432.75 and new highs for the year on crude 86.75 on WTI. Brent crude with a 91 handle earlier this morning. Under surveillance this morning, jobs data on deck.
So many people are coming into the labor market, and then you're still going to get wage pressures that are coming off. So when you talk about a Goldilocks scenario, right, that's going to be a report that says the economy is still strong, but it's not something that gives a definitive signal to the Fed that they need to cut very soon here.
Here's the latest this morning. Less than 2 hours away from the March payrolls print. Sarah House and her team at Wells Fargo expecting a gain of 220,000 jobs, slightly higher than the median estimate in our survey calling for a print of 214. Sarah writing this: as we move through the year, we expect to see payroll growth downshift further. However, with payroll growth still flying north of 200k, there is altitude to lose before the Fed is faced with a more menacing trade-off between the employment and price stability sides of its mandate. Sarah joins us now for more. Sarah, do you think right now we do have, though, that kind of asymmetric reaction function of the Federal Reserve where they're going to be more sensitive to weaker data than they are stronger data?
I do think that's the case. So I think especially when it comes to the labor market, where if you can continue to see the labor market chugging along, payroll growth north of 200,000, I think that gives the Fed the sense that they have time on their side to see what the next few inflation prints do and whether you can continue to see inflation or at least resume moving lower after the past couple months. But I think they are attuned to the fact that if you do see the labor market soften, that maybe they don't need need to wait as long on that inflation side.
Given the fact, Sarah, that we haven't seen the softening and that actually the whisper number from Bloomberg estimates is more close to 233,000, how close are we to seeing a real shift at the FOMC? Maybe not to no rate cuts like what we heard from Neel Kashkari, but maybe, as John was saying, to just 2 this year as the baseline.
Yeah, I don't think it would take much at this point. If you look back at the March SEP, of course, the median was at 3, but it was only by 1 voter. So that was really just hanging on to 3 by the hair of their chinny chin chin. So I think if you get another strong couple CPI prints, PCE prints, that it wouldn't take much, I think, to push back at least the timing of that first potential rate cut, as well as maybe the potential magnitude of how much they actually get done this year, just given how cuspy it seems a lot of Fed officials' thinking is at this moment.
Sarah, we've been talking a lot about the view that we got from Andrew Hollenhorst about twice as many rate cuts this year than the market is currently calling for, and a sudden deterioration in the labor market that they foresee for the second half of this year. Are you still on board with that type of deterioration as being a high likely event, given the fact that we continue to see strength?
So our base case is that we'll see the jobs market soften as we move through the course of the year, that we'll see overall payroll growth moderate. So over the past year, we've added about 230,000 jobs. We think that the trend for the last 3 quarters will be probably somewhere closer to 130,000. So I think we will see some more weakness, but I don't think it's going to be really a sharp deterioration in terms of an emergency type situation. I think in part this is just the lagged effect of monetary policy finally feeding through into some businesses' hiring decisions, the fact that they are back to fully staffed after what's been a couple hard years to get workers back in their seats. And I think with that, we will see the pace of job growth slow. But again, there's a lot of altitude to lose, I think, before you get to a point where payroll growth is really worrisome for the Fed at this point.
Sarah, it's been pretty impressive to see jobs growth of north of 200K and not squeezing out more wage growth off the back of that. It just hasn't been as inflationary as we might expect it to be. Is that about Fed policy, or is it just about a leaky southern border? Which one is it?
I think it's certainly been about the overall growth in the labor supply. So part of that has been strength in terms of the foreign-born workers. So we've seen those grow about 4 times as fast as native-born workers over the past couple years. But we've also had pretty strong growth in terms of the native population, with participation coming back. But if you look at the labor supply going forward, I think while we're continuing to see some strong population gains, the other part of that labor force growth equation, the participation side, that's really leveled off over the past 6 months or so. And so that's going to limit how fast the labor supply can continue to grow. And if you're not seeing as much strength there, that's going to make it harder to get wage growth to cool further without seeing that more meaningful slowdown in demand and overall hiring.
Jay Powell talked about this earlier this week. He said the capacity of the economy moved up more than the actual output, because of Jonathan's point, the leaky southern border and the immigration flows. Can you quantify exactly those numbers in terms of immigration flows with U.S. labor force participation?
Well, the BLS does try to capture this in terms of the foreign-born and native-born workers. And as I mentioned, we have seen the foreign-born labor force grow about 4 times as fast. Right now, the 12-month rate of increase in terms of the household measure of those foreign-born workers is closer to about 140,000, where we've actually seen the native-born decline by, I want to say, close to 50,000 12-month average. So there are some numbers around this. It's coming from the household survey, so there is some volatility there, and you have to see that somewhat cautiously. But certainly, we've seen a lot of the labor force growth come down to those foreign-born workers in recent years.
Sarah, thank you. Appreciate your words this morning. Sarah House there of Wells Fargo. I won't make this conversation political. There's a better forum for that. It's not this one right now. But if this is about the southern border and not about Fed policy, it really does raise questions about how you set monetary policy for a labour market like this one. How do they know they've got the appropriately set monetary policy for a labour market like this when it has nothing to do with what they're doing?
You don't, which is the reason why everyone has just a completely different view on what the neutral rate is, on what they should be doing, whether we should even, as Priya Misra says, and she's coming up, thinks that maybe we should even be considering a rate hike if we're really going to price out some of the rate cuts this year.
Priya Misra of JP Morgan coming up next, together with Steve Englander of Standard Chartered, NATO Secretary General Jens Stoltenberg, and Bloomberg News Editor-in-Chief John Micklethwaite, alongside Mr. Milei, President Milei from Argentina. That conversation in the next hour of Bloomberg Surveillance.
We think inflation is going to be showing progress towards 2 over the next few months.
There's some forces out there that are structural and they're militating in favor of lower inflation.
Inflation is an insidious thing. It takes time to get rid of.
At the end of the day, it's all going to be coming down to inflation.
Inflation is probably not going to average 2%. It's probably going to average a bit higher than 2%. I don't think 3 rate cuts are out of the realm of possibility.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The payrolls report 90 minutes away. 214K is the estimate. The previous number 275. The second hour of Bloomberg Surveillance begins right now, following the biggest one-day reversal we've seen in quite some time. The biggest one-day loss on the S&P 500 since the middle of February. And at the epicenter of the price action this week, it's not been about stocks, maybe not even treasuries. It's been about the commodity market and Brent crude.
Oil prices rallying some 20% so far this year. When I start to think about just how big that rally has been, it sort of is a gut check in terms of the creeping higher and then all at once. And it raises this question. Julian Emanuel put it really well from Evercore ISI. How challenged right now is the Goldilocks narrative? And that, I think, is what's giving people some pause.
And here's the challenge. It has a number, 91, in front of it. Brent crude right now, $91 and about 6 cents, positive by 0.5%. WTI crude up 1/3 of 1%, getting closer to 87. We talked about that tension between the US and Israel. Really, this is about the potential for direct confrontation between Israel and Iran.
Absolutely. And Benjamin Netanyahu made that very clear yesterday. RBC yesterday came out with a note saying it's their understanding that the Iranian response to this Israeli bombing at this consulate in Damascus is going to be more forceful than previous retaliatory actions. And that is why you are seeing this risk really creep into the oil market.
This has caused big swings in this market, cross-asset, throughout the whole of this week. So let's get straight to it. Equity futures at the moment on the S&P positive by 1/3 of 1%. Bond yields on quite a ride. We talked about the low and the high of the week, Lisa. 418 at the low end, 440-something at the high end, and somewhere in between right now.
I have to give a mea culpa. We've been discussing a lot. Why is all the Fed speak necessary? And then the next day, we parse through all the Fed speak and explain why it was so important to the market action the day before. So let's go there. Minneapolis Fed President Yael Kashkari coming out. If we continue to see inflation moving sideways, then that would make me question whether we need to do rate cuts at all. Feeding into a feeling that maybe on the margins, we may not get the rate cuts that people have been pricing in. And all of a sudden, it didn't matter until it did. And that might be what we're approaching.
And it won't come with strong growth. It might come with higher inflation. That's the added risk here with that move in crude.
Especially because we'd already seen manufacturing prices paid increasing. So you're seeing this sort of push to make everything more cheaply, to make everything more significantly than every other country around the world, fueling commodity prices, fueling industrial investment, and leading to this inflation that's a little bit more nefarious than just Goldilocks.
Brent crude right now at about 91. Coming up this hour, Priya Misra of JP Morgan looking ahead to payrolls data. NATO Secretary General Jens Stoltenberg on plans to fund Ukraine. And Bloomberg's John Micklethwaite with Argentina's President Javier Milei. We begin with our top story. Investors awaiting the latest payrolls report after a wave of Fed speak and eco data throughout the week. Priya Misra of JP Morgan saying this: if the Fed is not cutting rates, the market has to put some probability of the Fed hiking rates. And that brings up very unpleasant memories of September and October. The only safe place is cash. A very bearish sounding Priya Misra joins us around the table, and I'm sure you've got plenty of nuance behind that quote. So let's get straight to it. Are you saying we could be confronting a September-October moment all over again?
So I think, sort of the economic outlook and the Fed reaction function, both are important. I think what we're hearing from the Fed is patience on inflation. But, they can only be patient for that long. If inflation continues to head higher, if this was not a bump in the road, if the Fed pushes out these rate cuts further, if they talk about no rate cuts, the market has to put a probability of hikes. The moment you talk about hikes, all the money that's coming into fixed income, that's going into equities, I think that starts to retreat, stays in cash. Then we're talking about who's the marginal buyer of duration, who's the marginal buyer of risk. That's the fear, I think, that for the first time, I have to say this year, I saw saw that fear. Rates have risen, through the first quarter. We went from below 4% to 4.30. The market said that's fine. I think if in the inflation data, that's why I'm watching that wages number. I think what's giving the Fed confidence to be patient on inflation is that wages are moderating. We're getting 250,000 payroll growth, but yet wages are moderating. You get a 0.4 today on wages. I think that's really bad news, irrespective of what the NFP number is, a 0.4, 0.5. I think that's going to make the Fed think, oh, maybe policy is not restrictive enough. Maybe we don't need to cut. And then this whole soft landing narrative, I think, unravels.
Lots of ifs there. It's clearly a risk. Is it a risk I need to confront right now?
I think the market's dealing with that risk right now. I would say let's wait for an hour. We get the payroll report. Our view is that the supply side's actually working, meaning the foreign bond population growth, the fact that supply chains have improved. And so our sense is that the labor market's normalizing. The extent of growth in the population is going to allow wages to continue to moderate. You get a 0.4, I think we're going to hear some members of the Fed starting to say, well, maybe we don't need to cut. We heard that yesterday. Now, it's only from one Fed official. I have to say even the hawks have not talked about hikes or not needing to cut. I think the Fed is looking at cumulative progress on inflation, but we're not at the target. So if you get a 0.4, and then we have CPI next week, so you can't really relax even after 8:30 today. If CPI comes in at 0.3, 0.4, well, then can the Fed maintain their view that inflation is moderating close to 2? So I'd say the next few days is extremely important for this, can the soft landing narrative continue?
I love this parental. Let's wait for an hour. Of course, you can't remain easy until CPI next week. Nobody wants to wait. Nobody can wait. And everyone's trying to figure out how to trade. Am I hearing from you that you actually are questioning the long duration trade, especially as you see cash as really the haven asset class?
So it's all about valuations. If the 10-year was at 4% right now, I would say, well, maybe we should not be getting into duration. We backed up. I think the rates market saw this and said, oh, okay, maybe inflation's high. Maybe the Fed doesn't need to cut 3 or 4 times this year. At 4.30, 4.50, if we do get a further backup, we'd be buying backups. I will say that we're buying it nervously. Maybe you don't put all your, all your risk on, because if you get a 0.3, 0.4 on inflation next week, then rates can continue to back up. I do think as long as they're not talking about hikes, 450, 460 is the high. We're at, getting close to that level. So I'd still say buy backups unless the next couple of data points suggest that the whole disinflation narrative is not a bump in the road. It's the start of a new trend.
So there are two aspects here. One of them is the duration trade, which in the past you've nervously liked. And the other is the credit trade, which you also have nervously liked at a time where you supposedly had been seeing this ongoing strength. What would you have to see in the labor report to challenge one of those in a much more aggressive way?
So duration, I think, is the clearer one where I would get nervous. If we get a 0.4 today on wages and a 0.4 on CPI, I think you're supposed to stay away from duration. Wait for 450, 460. On credit, I have to say the fundamentals are still very strong. We're looking at company earnings. We're looking at companies are not levering up. So the fundamentals of the corporate sector are extremely strong, particularly in high grade, whether it's high grade investment grade, high grade, high yield. I think fundamentals are strong. The other part is technicals. We're still seeing yield-based buyers. These spreads are tight. To your point, spreads are extremely tight. But people are looking at all-in yields of 6%, 8% in high yield. That money is continuing to come in. So I'm a little more confident around credit. But we'll watch those flows. And if people start to get nervous that the ag is down on the year and that money starts to leave out, then I think you start to get nervous.
So you fundamentally disagree with Citigroup's Angie Hollenhorst that the risks are balanced to a weakening potential in the economy. And you see the risks as balanced, I might be paraphrasing you, correct me, as really being a sort of overheating inflationary environment that really gut checks whether this Federal Reserve has done enough.
So I think the Fed is telling you that the risks are balanced. I thought that was interesting. From the Fed, all we heard was inflation the last year. Now what you're hearing is, well, it's inflation and growth. They keep talking about their dual mandate a lot more. I think they're telling you if things slow down, they'll cut a lot more. So they're trying to say that the risks around those 3 cuts are balanced. But here's the problem. The economic data, I think, given the easing in financial conditions, given the strong, how resilient the corporate sector is, how resilient the household spending numbers are, that's where the risks are a little asymmetric. So if the economic data suggests that growth is actually accelerating, And inflation is now with the oil move, though I think if it's just oil, that's a tax on the consumer. That actually doesn't mean that the Fed should hike a lot more. But what if it's everything else? If service inflation doesn't decline, that's where that asymmetry comes from, which is making me nervous around, piling on in terms of duration or credit, would be if the economic data doesn't cooperate. Soft landing really has had the Fed working for it. We just need the inflation number to work for it.
You're questioning a key pillar of this whole rally, which is this perceived dovish central bank stance, this perceived dovish policy reaction function. Are you saying it's the wrong interpretation of what's happening at the Federal Reserve?
I think it's a patient narrative. I think they're trying to say this is a bump in the road. Maybe bump is the new transitory. But what they're telling us is, this is not suggesting that inflation's not moderating. But how many months can they be patient? If you get a couple more months of service inflation, we know goods disinflation's done. If service disinflation doesn't continue to slow down, I think that's where this Fed patient narrative is going to run thin.
Can I quote you for the rest of the morning? The bump is the new transitory.
We will.
I think that's absolutely brilliant. Can you tell me how many bumps in a road before it's no longer just a bump and it's a problem? Can we kind of figure that out? What does that look like?
I think a couple more. I think that's why this week was so interesting. I think the next few data prints, the first one you can ignore, the second one you kind of get nervous, the third one, and as a former research analyst, not to draw a trend with 3 data points, but you start to say, ooh, and then at the margin, people start to get nervous. So I think the next 2 months, if you don't get, June cut gets pushed out, and then we have an election coming up. So now we're talking about no cuts this year. That would be that would be a big problem. I think it's key. Soft landing requires the Fed to cut rates. I think this is what not everyone's on board, but I think with real rates, 10-year real rates at 2%, that is restrictive. Not for the entire economy, it's restrictive for certain parts. So if the Fed doesn't cut rates this year, I think we have to question, can the economy stay this resilient?
How far away are we, just to go full circle, are we from this market pricing in some probability of rate hikes, not just cuts?
I think if you get more Fed officials saying, let's not cut rates, the market's going to start pricing in some probability. You'll see it in the options market because we should price in all outcomes. And if there are some saying, well, no cut, well, then some on the fringes will start saying, maybe monetary policy is not restrictive enough. And then we have to cut, we have to raise rates. So I think you get a couple more saying no cuts and then hikes come back on the table.
Priya, this was great. You're going to stick with us. Priya Misra there of JP Morgan Asset Management. Equity futures positive by 1/3 on the S&P. Let's get you some stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Argentina's President Javier Milei praising Donald Trump's protectionist policies in an exclusive interview with Bloomberg. He told editor-in-chief John Micklethwait the former U.S. president's trade barriers were justified in the wake of China's reluctance to float its currency during the global financial crisis.
Lo más valioso
The greatest value of Donald Trump's policy is that he has rightly identified the enemy, and the enemy is socialism.
His comments are in line with his decision to speak at a pro-Trump political convention outside Washington back in February. Emergency crews in Taiwan are continuing efforts to reach the hundreds of people stranded under debris after the area's worst earthquake in 25 years. Emergency personnel saying on Thursday that over 600 people remain trapped as a result of the 7.4 magnitude quake. The government announcing the death toll has risen to 10 people with over 1,000 more injured. The Oakland A's will be making a pit stop ahead of their planned move to Las Vegas. The team announcing that they'll be playing in West Sacramento for 3 seasons beginning next year. They'll be playing in a 10,000-seat minor league stadium while their future ballpark undergoes construction. The move marks an end to the A's 57-year run in the Bay Area. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, a resurgent US dollar.
Meaningful dollar weakness in my mind really begins with an aggressive rate easing cycle, right? Some of the mid-cycle adjustments that we're currently pricing for this year anyway, probably not going to do it.
That conversation up next, live from New York City this morning. Good morning. payrolls report, jobs report about an hour and 15 minutes away. Your equity market on the S&P 500. Equity futures positive a third at 1%. That was a terrible joke.
Dad
Short
joke.
break.
Got lots of them.
So you're trying to keep it together. It's like a joke for you. Do you want to share it?
No, it's good.
Didn't think so. Yields up 2 basis points on a 10-year, 4.3335. Under surveillance this morning, a resurgent US dollar.
Meaningful dollar weakness, in my mind, really begins with an aggressive rate easing cycle, right? Some of the mid-cycle adjustments that we're currently pricing for this year anyway, let's call it 2 cuts or so, probably not going to do it. We're going to need to do a little bit more.
Here's the latest this morning. The greenback gaining against almost all of its major peers in 24. Investors wondering how much more room it has to run. Steve Englander of Standard Chartered writing this. We continue to expect the Fed to cut rates in June. We think this will support risk appetite in asset markets and lead to moderate dollar weakness, even if other G10 central banks follow suit. Steve, I'm pleased to say, is with us now for more. Steve, can we start with the Fed, and can you tell me, Bostic, Kashkari, how much company have they got on the FOMC?
So far, they seem isolated. I'd say, Kashkari isn't a voter this year, so he can pretty much say what he wants. I mean, Bostic and to some degree Waller sounded as if they were willing to dissent, given that they're voters and they were so adamant about cutting in the second half. I think, though, that the Fed and Chair Powell has been prepping the market for dissent. So, I mean, he's had a couple of questions on it at recent meetings and said basically, yep, we'd like unanimity, but we can live with dissents.
I don't understand why the idea of the dollar weakening is the most likely path of things if the U.S. economy continues to outperform. And there really are increasing questions about whether the Fed can cut at the same time that people are basically saying it's a given that the ECP is going to go in June.
Well, I think that logic is why we are where we are, right? With the, dollar around, euro dollar around 108.50. And what you've seen is an ECB that looks like, I don't want to say desperate, but pretty committed to cutting in June. And they can't even shut the door entirely on sooner, talking about spring cuts. But I think the other side is that, if the Fed does go ahead and cut in June, as we expect, other central banks cut, barring geopolitical events, it should be a pretty risk-on environment. And that risk-on type of environment tends to be dollar negative. It's not super dollar negative. You'd need some yield compression there for it to be a stronger dollar negative, but it's still there. I would say that you look at the market, the one characteristic of the market all year long is that the market seems a lot happier selling dollars than buying dollars. The same quantum of dollar positive information doesn't take the dollar up as far and for as long as the same quanta of dollar negative information. So I think that tells you something about where the market wants to go.
I will say that some people are probably screaming at the screen right now and saying this is a loss of fiscal dominance by the United States. How much is that part of the story, especially as we see gold rallying to such a degree, that traders are betting that on the fringes, you're going to see central banks diversifying with gold rather than just consolidating all of their holdings with the U.S. dollar? How much is that behind this desire to sell and not buy as much as previously expected?
Well, I think it started with the, geopolitical stance of the U.S. and the willingness of using the, dollar clearing system as, sort of a tool, a weapon in geopolitical disputes. There's a bunch of countries that would prefer to avoid dollars if they can. I think the fiscal dominance picture is there, but and it's probably gold positive. But I think people would love to have another asset that was more liquid and bigger in terms of being able to avoid fiat currencies. And it's pretty clear the dollar's not the only, or the U.S. is not the only country with fiscal issues. Their debt profile looks just like everyone else's.
Steve, putting gold aside, what other currencies are countries trying to avoid because of what is going on in the U.S. policy when it comes to the dollar?
I think that if you're talking politics, I mean, it's been a G10 NATO type of move together over a period of years in terms of sanctions and other issues. Look, European debt picture isn't great. Nobody's debt picture is that good, except for a few small countries. I think it's a very hard choice as to say what else, and the market is constantly probing whether it's Bitcoin or gold or some other asset that's going to be bulletproof in the event that fiscal issues become more important than they've been till now.
Hey, Steve, thoughtful stuff. Steve Englander there of Standard Chartered. Thoughtful stuff coming in from Neil Dutcher of Renmark on a Bloomberg. Just asked Neil, what are you looking for today? Do you know what he said? Above zero, below 500K. I said, helpful, Neil. Give me more. So he gave me a quote. This is more helpful, OK? If the Fed thinks labour supply is a reason why jobs growth is strong, then there is an asymmetry here. A strong number won't push them away from cutting as much as a weak number will push them to a cut. Priya Misra of JP Morgan alongside us. Priya, would you endorse that view of things?
I agree, but I think it's all about wages. If you get a strong number with a 0.4 wages, the Fed is going to get nervous about this idea that they can be patient around inflation.
Would that challenge the supply side narrative if we start to see that in wages?
I think it would, because if you've had all this labor supply, then that should moderate wages. If wages are picking up, then the labor market's tight enough that despite all of this labor supply, it's not moderating wages. So I would say watch that average hourly earnings number. It's not a perfect number for wages, but it is the most high frequency number we get for wage inflation.
I want to go back to the quote of the morning. When is bump becoming the new transitory? And this question of, are bumps not all the same, right? Are some bumps more significant than other bumps? Which bumps, and I'm talking about potential economic reads that could come in hotter than expected, could really change the narrative in a more material way?
Yeah, I would say it's wage inflation today. It would be in the CPI report, CPI services, and perhaps CPI services ex shelter, because we know that shelter is moderating. It's moderating slower than I think the Fed thought, than we thought. But ex shelter, what is happening to that rest of service inflation? Because shelter is really a function of rent growth, which is slowing. It's just taking time. Is service inflation moderating? I think if the CPI number is as expected, but service inflation is not moderating, the Fed's going to get nervous because, we had significant moderation in that in the second half of last year. That slowed. And if that continues to slow or goes the other way, I think that's when they're going to get nervous.
I'd love for you to weigh in on Steve Englander's point, this question that people are looking for ways to diversify away from the dollar, that potentially this could be a trend going forward. Are we seeing any signs of that in terms of peripheral buying in the Treasury market? That there's a question, despite some of the strength, that maybe this isn't going to be the haven asset or the place that people want to park their money?
So it's still the haven asset, I think, overall. And the reason I say this is it's the most liquid capital market in the world. You can buy treasuries, sell treasuries very easily. But I will say, look at foreign demand for treasuries. It's been weak, not just this year, it's been weak for the last few years. Some of it is because the FX hedging costs were high. Some of it is people are looking to diversify. So who's going to be the marginal buyer of treasuries? I think we have to get used to the US market being the marginal buyer of treasuries. And who's that? US households. It's mutual funds, I think, and these are price-sensitive buyers, which is why it's so important. If rates start to go higher and you realize, where's the cap, and the distribution of outcomes start to widen, these price-sensitive buyers step away. So I think this is a longer-term issue. We have tax cuts expiring next year. This is something Congress has to grapple with next year, that if the entire Treasury market demand base is all US, then they have to have a sense of the fiscal trajectory, which we don't really have a great fiscal trajectory right now. So that's a long-term issue. But the Fed, I think, can drive where those rates go. And if they're not talking about hiking, I think Treasury yields are capped.
Well, doesn't that just mean the Fed would have to step in if households aren't going to be able to do it?
Well, the Fed will step in if the dual mandate makes them step in. Right now, growth is strong and inflation's above target. So the Fed can't step in right now, which is why we had that September-October timeframe. The Fed's doing QT, data is strong, they're not stepping in, and you have to wait for the US household to step in to buy. And then if you realize, the Fed might hike, you're not buying at 4%.
I've loved this, Priya. It's great to see you. Priya Misra there of JP Morgan on why bumps in the road might be the new transitory in the economics field right now.
Well, it's a fantastic quote because it highlights why people haven't paid attention to the bumps in the road and when all of a sudden they start to matter a whole lot more. The whole quantitative tightening thing. Yesterday was Thursday. At 4:30 p.m., the balance sheet comes out, and I do always look at it.
Just thinking, thank you for telling me yesterday was Thursday.
Carry on. Anyway, if you wanted an update, yesterday was Thursday. Today is Friday. Just looking, it's gone down $1.5 trillion over the past number of months. That's significant. Paint dry, evidently.
It was always interesting, wasn't it? Watch QE. It's really important to stimulate the economy. Don't watch QT. It doesn't do anything.
Yeah, but this is fascinating. Has it? What has it done? We don't know.
Equities right now positive 1/3% on the S&P, up about 1/4. Up next on the programme, NATO Secretary General Jens Stoltenberg. That conversation just around the corner. "60 minutes, 1 hour away from the payrolls report. It's just around the corner. Going into it, equity futures. The scores look like this. Positive 1/3% on the S&P, up 1/3 on the Nasdaq too, up 1/4% on the Russell. The small caps trying to bounce back from the biggest one-day loss on the S&P 500 since the middle of February. Plenty of you writing in with some really interesting things. Neil Dutter of Renmac, we talked about a quote from him just moments ago. If the Fed thinks labour supply is a reason why jobs growth is strong, there is an asymmetry here, Lisa. A strong number won't push them away from cutting as much as a weak number will push them to a cut. That's how the market perceives this sort of dovish central bank stance right now.
The Fed put that's just sort of been implied within this market action that we've seen for a while. The one caveat to that, and this is sort of the shift that we've seen in the narrative over the past couple of trading sessions, maybe the growth picture isn't cooperating. And if you really start to get the sense that there is true weakness, and that is what the Fed is going to need to respond to, that's not the greatest news for risk assets, and they're potentially sniffing that out.
Right now, the Federal Reserve is embracing this supply side narrative, so they don't see strength as a problem. Priya Misra right to point out wage growth. If you start to see wage growth come through a little bit more strongly off the back of higher than expected payrolls growth, does that question the supply side story, and does that disrupt this market move?
It raises this issue of you still have a very tight labor market that isn't being offset to the same degree by immigration and other potential increases to the labor market. If that's the case, they might be challenged to really believe and have conviction that inflation's heading down to 2%. You're already seeing some splintering. Neil Kashkari, Raphael Bostic, do you see others start to come along as bumps become the new transitory?
I love that line from Priya Misra. It's just fantastic. Let's switch up the board and turn to bonds briefly. Talking of swings, not just the equity market this week, but bonds as well. Just the range on the 10-year, even though the 2-year's been pretty anchored, to see sub 420 and something above 440, all in just a couple of days, Lisa, off the back of tons of data, lots of Fed speak. And I would argue we've got to work out, is it about the data? Is it about the Fed speak, or is it just about the price of crude in the last 24 hours?
And this, to me, is the price of crude really an isolated type of metric, considering the fact that we've seen a rally in a whole host of commodities, and you're seeing industrial production increase. We heard that from Priya. If it's just crude, that could be disinflationary. If it's everything, not so much. And if consumers can keep spending, well, then you have an issue where it becomes a more intractable problem. Taking a step back, we're looking at a market now that's questioning Goldilocks. And that, I think, is a real issue for whatever we get today out of the jobs market. It won't be as much of a knee-jerk buy because the Fed has your back no matter what.
Basically what Priya said just moments ago. Really interesting conversation. If you want to go back over it, you'll find that on Bloomberg.com and on the Bloomberg terminal a little bit later on this morning. Let's turn to foreign exchange. I want to finish on the euro. The euro at the moment just about unchanged. Bit of a snooze at the moment. Euro dollar 108.34. But I think a question we keep returning to is, does this ECB need the comfort of the Federal Reserve cutting in the month of June for them to go and signal they're willing to go a whole lot further?
There are a whole host of notes overnight basically saying the ECB is going to go in June, and now it's just the sort of countdown clock, and they don't need the Fed. Question is, how long can they go it alone before the Fed has to either join forces and keep cutting or start cutting, or see a real protracted weakness in the euro?
Euro dollar just about unchanged on the session. Under surveillance this morning, the March payrolls report due out in just about an hour. The median estimate in our survey calling for a print of 214,000. Wall Street out with a wide range of estimates. You've got Morgan Stanley at the high end looking for 245. Citi at the low end, Annmarie, calling for 150K over a Citi.
Ben Amons overnight was talking about the fact that if you look at ADP leisure, if you look at ISM manufacturing employment, he's seeing that potentially today non-farm payrolls can come in between 225 to 250. Potentially, though, only it coincides with those when it is just a coincidence. But what does that mean in terms of what he says this now, what people are talking about risk off, risk on? Cuts on, cuts off.
You've got to pair that with what's happening right now with the Fed speak as well. Neil Kashkari of the Minneapolis Fed, the president, saying this: the Fed may not need to cut rates at all this year if inflation continues moving sideways. But Cleveland Fed President Loretta Mester suggested the central bank could be getting closer to the level of confidence needed to begin lowering interest rates. Now, Mester's an interesting one because when we get to catch up with Loretta Mester of the Cleveland Fed, often sounds like she's on the hawkish side of the spectrum at the Federal Reserve. It's not what I got from what I heard just yesterday from Loretta.
Basically, that the jury is still out and that she still needs a couple of more months, but otherwise things seem to be moving in the same trajectory. A similar kind of comment as we heard from Joe Biden, from Fed Chair Jay Powell. There's this question here about going forward, what it will take to unmoor the confidence by some of these officials that inflation truly is going down to 2%.
Fed Chair Joe Biden is a very different conversation. We can talk about President Biden taking a tougher stance on Israel. In a call with Prime Minister Benjamin Netanyahu, Biden saying US support for the war in Gaza depends on Israel taking new steps to protect civilians. Israel also bracing for a potential attack from Iran after Iran vowed revenge after Israel's alleged strike in Syria that killed senior military officials. And it was this story that started to evolve in a bigger way through the middle of yesterday that really started to fuel that move in crude.
Because analysts like Halima Croft are talking about the fact that they are expecting a bigger retaliatory measure than, say, we saw when Qasem Soleimani was assassinated by the United States. Going back to Joe Biden and this rift we're seeing with Benjamin Netanyahu, this morning Greg Valliere says a rupture in U.S.-Israeli relations, of course, would be an enormous victory for the terrorists in Hamas and Iran. That growing divide between Jerusalem and Washington is actually helpful to Tehran and Hamas.
Big move in oil. Lisa, big move in Exxon. Have you seen this move year to date?
It's massive.
20% year to date for Exxon.
These have been the biggest outperformers at a time where a lot of people are saying they benefit even if crude prices don't rally this much, just simply because they've got a lot of cash and they're returning it to shareholders. Then you get crude turbocharging the whole effort. You give the fact that they've got so much of the shale patch now with the acquisitions, and boom, they're the outperformers of the year.
A big move in energy stocks over the last few months in a big way. Let's turn to our next story. NATO allies weighing a new plan to provide over $100 billion in aid to Ukraine over 5 years. At this week's foreign ministers meeting, Secretary General Jens Stoltenberg proposing Ukraine be given long-term, multi-year support from the organisation. The plan would reshape NATO's current role in the country's conflict with Russia and limit Ukraine's reliance on Washington. Jens Stoltenberg, NATO Secretary General, joins us now. Mr. Secretary General, wonderful to catch up with you again, sir. I just wanted to start with some comments from the French President, Emmanuel Macron. A series of comments over the last month I'd love your response to. He hasn't ruled out eventual boots on the ground in Ukraine. He recently suggested sending personnel there, including the possibility of training troops in the country. I just wonder, sir, have you spoken to him directly about some of these proposals?
I'm in regular contact with the French president and other leaders in the NATO alliance, and what is clear is that NATO has no plans of deploying combat troops into Ukraine, but we will step up our military support to Ukraine with ammunition, equipment, weapons, so Ukraine can liberate more territory and prevail and as a sovereign independent nation in Europe, because that matters for Ukraine, but it also matters for all NATO allies.
Sir, could I be more specific? Sending personnel there to train troops, how risky is the training option in your view?
Well, again, as we are providing training, NATO allies are providing training for tens of thousands of Ukrainian troops. We have done that for many years, but that takes place now outside Ukraine. So our support is to provide training, it's to provide ammunition, weapons, but not to have combat operations inside Ukraine.
I want to also ask you about the fact of the former president coming back. That's looming large on some of these partners within NATO, especially when it comes to the Ukrainian Defense Contact Group, which is run by the United States. Is there a chance you bring that in-house so that NATO controls that and pretty much safeguards it no matter who runs the U.S.?
Well, we agreed at the NATO Foreign Ministerial meeting this week to start planning for a stronger NATO role in providing and coordinating support to Ukraine. The US-led contact group for Ukraine has played and continues to play a very important role. But I think that NATO can ensure that we have an even more robust and more predictable framework for our support to Ukraine. That's needed because the Ukrainians need to know that we are there for the long haul. So that's what we have started to do at NATO, and I expect a decision before the NATO summit in Washington in July.
Are there other areas you're trying to shore up NATO control because you are concerned about political instability?
Well, my proposals on a stronger NATO role is based on the situation on the battlefield in Ukraine, the urgent need they have to have more reliable, more predictable support. The need we have within NATO to ensure more fair burden sharing among allies. 99% of the military support comes from NATO allies, and we have to be sure that that burden is shared equally among allies. And then, of course, we also need to send a message to Moscow that we are there for long haul. Because now President Putin believes that he can wait us out. He has to understand that he will not win on the battlefield. He cannot wait out Ukraine and NATO allies. And therefore a stronger institutionalized NATO framework will send that message and then force him to sit down and negotiate an agreement where Ukraine prevails as a sovereign independent nation in Europe.
Secretary General, we talk almost every morning about the potential for Ukraine funding in the U.S. to be passed and how it's gotten hung up by politics again and again and again. How difficult does it make it for you to wrangle support to get to that $100 billion fund that you plan for the next 5 years for Ukraine?
Of course, it matters that the United States has delayed its decision to provide support to Ukraine. That's one of the reasons why the Ukrainians now have to ration the number of shells their forces can use, and why Ukraine is outgunned by the Russian forces. At the same time, we have to remember that European allies and Canada are providing roughly 50%, half of the military support to Ukraine. So it's not only the United States, it's also other NATO allies. But of course, the United States being by far the individual ally which is providing the most, it matters. And therefore, I really hope that the US Congress can make a decision as soon as possible. This is important for Ukraine, but it's also in the security interest of the United States to prevent President Putin from winning. And that will send a message to him, but also to President Xi in China, that when they use military force, when they invade another country, when they violate international law, they achieve their aims. That will reduce the threshold for any future use of force. What happens in Ukraine today can happen in Taiwan tomorrow. So therefore, it is in the national security interest of the United States to provide military support to Ukraine.
Secretary General Annmarie was talking about former President Trump coming back to power and how that's looming large. And I wonder how much those criticisms are also looming large that are not just isolated to Donald Trump, but others as well, saying that, frankly, a lot of NATO members have not contributed enough to the spending and to the financing of some of these efforts. How much reluctance are you hearing from some of the NATO members that haven't traditionally contributed as much to really helping fund or disproportionately fund that $100 billion?
So I strongly believe that it has been a valid point from the United States that European allies have not invested enough in NATO in defense. But that has really changed. We made a pledge in 2014 when President Obama was President of the United States to ensure that all allies spent 2% of GDP on defense. At that time, in 2014, only 3 allies spent 2% of GDP on defense. This year, we expect around 20 allies, 2/3 of the allies to spend 2%. That's a huge difference. It's a significant improvement. And when it comes to the extra money for Ukraine, one of the reasons why I want a stronger NATO framework, institutionalized framework around the support, is that that's a way to ensure fair burden sharing, to actually agree some kind of cost shares, or to agree a way to finance, and by doing it to NATO, we can ensure fair burden sharing, and that makes it easier to get all allies on board, also the United States.
Secretary General, we appreciate the ongoing conversation. Thanks for joining us this morning, sir. Jens Stoltenberg there of NATO. Your equity market on the S&P 500 near session highs up 0.4%. Payrolls just around the corner. Let's get to your Bloomberg brief. Here is Yahaira Hakez. Hey, Yahaira.
Hi, John. Home prices in the UK have come down for the first time in 6 months. The average house price dropped 1% to just under £290,000 in the month of March. That follows a 0.3% gain in February and slight increases the previous 4 months. The market appearing to respond to a dip in mortgage costs and the expectation that interest rates will fall later this year. Mortgage approvals surged in February to the highest level in 17 months. BlackRock unveiling new incentive awards as part of its succession planning. The world's biggest asset manager announcing its COO and global business heads each received $8.5 million in performance-based stock options. The incentive pay plan was approved for, quote, a select group of senior leaders who we believe will play critical roles in BlackRock's future. In total, BlackRock says it handed out a total of $120 million of the stock options. And Samsung sales missed forecasts in the first quarter, but preliminary operating profit rose sharply, ending a string of quarterly declines. The results underscore how demand is starting to rebound for memory chips that power electronics after a severe downturn in the industry. Plus, the Wall Street Journal reporting Samsung plans to raise chip investments in Texas to about $44 billion. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, Argentina's big inflation problem.
Today, wages are miserable, not through our own fault. That is due to 20 years of populism.
More on that exclusive conversation in just a moment. Live from New York City, this is Bloomberg. It is Payrolls Friday, your equity market trying to bounce. And this session high is up by 0.4% on the S&P 500. Looking for a number, based on our survey, the median estimate, a number around 200k. That data drops in about 43 minutes' time. Yields are higher by 2 basis points, 432.95 on a 10-year. And crude, near the highs of the year, just backing away a touch, 86.49. Under surveillance this morning, Argentina President Javier Milei facing an uphill battle. The country suffering triple-digit inflation and its 6th recession in 10 years. In an exclusive conversation with Bloomberg News editor-in-chief John Micklethwaite, he details his ambitious reform plans.
But still, and despite the put options and the interest-paying liabilities, what we inherited from the previous government, and after having bought almost $12 billion, what we have sterilized through the purchase of the BOPREAL, and as regards the fiscal surplus, the money base hasn't changed. So we are cleaning up the balance sheets of the central bank, and in so doing, the long-term price level shrinks because we are shrinking the nominal scale in the economy, and the slope is reduced and the inflation rate comes down. This is why it is so important to clean up the balance sheets of the central bank to get rid of that pressure. Once we achieve that and are able to undertake the financial reform in order for there no longer to be the possibility of issuing rediscounting, the financial reform actually has to move towards a free banking system integrated with the capital markets so that there are no runs and all the imbalances are cleaned up through prices. In that context, if you also have your public accounts, government accounts in order, and you don't use the central bank to finance deficit, and if you also lift the currency restrictions, well, the first thing you need to do is clean up the central bank balance sheets. Once we've done that, there's the anti-issuing law. One very key attribute of which is that this will make it a crime against humanity and not time-barred if you issue money. It may well be the case that once we leave office, someone may come along and want to change that. They may do that, but then someone else might come back and lock them up in prison for doing that.
These might all be very admirable reforms, but at the moment, if you are an Argentine living here at the moment, there is short-term pain in the same way as there was with Margaret Thatcher, with all the people who you admire. And I just looked at the statistics. They're quite frightening. The average salary in Argentina is at its lowest level since 2003. 57% of Argentines live in poverty. Consumer spending dropped 23% in February. So far, the interesting thing is your support has stayed high at 50%. But do you accept that there is a time limit on how much pain Argentines can take to take these reforms?
Lo primero es que
The first thing is, the way we see it, there has been a cultural change in Argentina. And most Argentines have understood that the solution is not populism. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. When you take the average wage of Argentines back in the 1990s and update it to today's currency, that would be $3,000.
You can catch the full interview on Bloomberg.com and on the Bloomberg terminal. I'm pleased to say that joining us now is John Micklethwaite. John, this is one of the big characters on the international stage. Can you share with us how things are going on the ground after the first 100 days?
Well, it's one of the most extraordinary economic experiments I think anyone has seen. I've been coming to Argentina since the 1980s. I interviewed Carlos Menem, who also has rather magnificent sideburns back here then. He tried to bring down inflation. It ended up in riots and civil unrest and stuff like that. This man, Milei, is somebody who is a free market fundamentalist. He calls his dogs after people like Milton Friedman. He used to be an economics professor, and as you heard there, he hates profoundly the idea of central banks printing money. So his long-term aim, he still claims, is to dollarize the economy, close down the central bank, and replace the dollar with the peso, replace the peso with the dollar. The truth and what's happening in between, and he's somewhat discursive in his answers, I think would be a way of putting it. Behind that, it looks like he's having to compromise a little bit for two reasons. Firstly, he hasn't got much support in Congress. He himself is popular, but he doesn't have many people from his party in Congress. And secondly, because I think there is a limit to how much pain Argentines can take. The inflation rate here is, he's reduced it to 13% a month. It's still unbelievably high, and people's savings, people's money is disappearing regularly.
John, what do you notice is the difference between the man on the campaign trail, the big plans he had, and what he's been able to execute so far in the first few months?
Well, he's kind of calmed down a bit. on the campaign trail, he called China an assassin. When I asked him about China in this interview, he sidestepped that a bit and said they had to get on with people. I think Lula and the Pope, he both called them communists. He calls the people who run the Congress, he talks about the caste. He runs very much on a somewhat kind of Trumpian, I'm against the establishment way of looking at things. But the fact is he has to get some kind of deal through Congress. He has sent in an enormous series of reforms which Congress shoved back at him. Now he's trying to go through to the governors. But to give you some idea of how much he's thinking of taking out, at the moment the Argentine state is around 37% of GDP. The current set of reforms he sent to the governors are reducing them to 22%. This is kind of Thatcherism on steroids. It's much bigger, much more dramatic, and the only thing he's got going for him, I think, is the fact that Argentines have had 100 years of false dawns, false promises, all those things. This used to be, I think, the fourth richest country in the world just over 100 years ago, and it has gradually gone down. He is promising kind of honesty and truth, but that's very, very difficult if you've just seen your pension reduced by 30% in a year. It's a very tough series of proposals he's trying to push through.
John, you mentioned China. How is he grappling with the reality of dealing with China as opposed to the plans he had?
Well, in theory, he's very against China because he hates socialism and he he called them assassins. But, the basic fact is he has an $18 billion swap line with China, and he has virtually no other reserves. So that, I think, exercises some degree of caution on him. There's a kind of row here at the moment to do with a space station, which the Chinese are building down in Patagonia, which sadly I didn't get to visit. But they're building it there, and the US is saying, look, this is a military purpose. And there's that was sort of an opportunity for Milei to say, no, I'm going to close it down for you. It's sort of obvious at the moment that he's unlikely to do that. And so he's having to, he's having to deal with it. We've got a long, big take about this today. You have this man who's come in really advocating exactly the obvious opposite of everything that China is. But he's having to make compromises. And one rather weird part of it is actually the Chinese are no longer investing quite so much in Latin America as they did. But Argentina is unusually on the hook to them. So they have dramatic degrees of leverage here.
John, an absolutely fantastic exchange. Fascinating stuff with one of the biggest characters in international politics and one of the biggest experiments taking place right now in international economics. Coming up very shortly, Nadia Lovell of UBS. We'll catch up with her, head of payrolls, 34 minutes away.
The jobs market is showing that there's resiliency.
That's probably going to be the most critical piece of data that we're going to be looking for at that report is what happens with the average hourly wages.
If those wages tick up or stay sticky at 4%, then we'd have to adjust our expectations for the Fed.
There is more resiliency in the labor market. The economy continues to power forward.
This labor market, John, is just amazing. If we see a 213 or a 250, I wouldn't be surprised anywhere in between, which definitely demonstrates a very resilient labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This is it. This is what we all get out of bed for. It's payrolls, 30 minutes away. At least some of us do. Anyway, 214,000 on payrolls is the estimate. The median estimate, 214. The previous number, 275. All eyes on this one as this market has been whipsawed from equities to bonds to crude over the last week.
And really, Priya Misra set it up perfectly. How many bumps can we tolerate before it becomes something that is stickier and that we have to take seriously? She's pointing to average hourly earnings, aside from just the benchmark number. How much do we start to see a resurgence in just how much people are getting paid?
Will we disrupt that supply side story that this Federal Reserve has embraced because they don't have to worry about strength of the economy anymore, because that strength won't come with punchy inflation numbers? You get wages starting to surprise to the upside. Do you disrupt that Goldilocks theme in this stock market?
Yeah, potentially, because all of this is inflationary. And I think today's print will really start to show what is the Fed potentially leaning towards. Priya Misra talked about this. She does feel like they're really starting to encompass the dual mandate. They care about both. Jay Powell was asked about this. If you had a crystal ball, which one would you look into? And he really said, you're trying to make me single-minded. We are a dual mandate. But I think today's print can really shed a lot about their path.
Well, the man on the Fed we all want to talk about is not Powell, it's Kashkari. And we've been saying all week, how many friends does Kashkari and Bostic have? Kashkari and Bostic are basically saying maybe one or nothing throughout the whole of 2024. And maybe if you think you're going to get just one, you might have to wait until the end of the year, Q4 2024, before we even do anything. And that introduces all the politics, and that's something they don't even want to talk about.
The data hasn't cooperated. The strength that we've seen so far has really given a lot of people pause about how much the Fed is actually effectuating a restrictive policy. Do we get signs from this labor market report that ongoing strength in the labor market is coming from the bottom up, not just people who are flooding into the country from other places and taking jobs for lower wages, which are driving down the potential inflationary forces and leading to a robust economy? How long can that story keep holding for this Federal Reserve?
Some big debates through the next 60 minutes or so. Let's turn to the equity market. Equity futures near session highs, up by 0.4% on the S&P 500. In the bond market, yields higher by, let's call it a couple of basis points on a 10-year, 432.95. In the commodity market, $86 at about 70 cents on WTI. We're positive there by 0.1% and printing new highs for 2024. With us through the next 60 minutes, we'll catch up with Nadia Lovell of UBS on why she thinks the market rally has more room to run. Former Fed Governor Randy Kroszner on the Fed's path forward. And we'll speak to Mohammed Al-Erin of Queen's College, Cambridge, reacting to the payrolls report from Lake Como, which is highly depressing for us all to see. Why don't we go to that?
Can I just say, Ellen Zentner, her background, she looked like she was coming from Never Never Land.
Right.
And then we started hearing other fairy tales, and I'm thinking to myself, how can you be pessimistic in any way, shape, or form?
I thought when I joined Surveillance, we were going to be going to Lake Como.
That's what they told you? That was the trade?
That was the trade.
Not the trade. Not the trade, apparently. Because I thought the same thing. You get to go to Villa d'Este, TK goes with you, and then it stopped happening.
False advertising.
Right.
They roped you in and
twice
then bait
a year
and switch.
as well. They would go twice a year. Better times, good times. Maybe not better good times. We begin with our top story. The payrolls report 30 minutes away, and stocks are looking to bounce back from yesterday's sell-off. Nadia Lovell of UBS saying this: as we look to the second quarter, we expect the S&P 500 to be well supported by further easing of financial conditions and earnings growth momentum. Nadia joins us now for more. Nadia, it's been quite a journey already through 2024, and it's good to catch up with you. Originally, it was something like 4 cuts, then it was 3. Nadia, where are you at for 2024?
You know, we have been there for some time at 3 cuts starting in June. It's clear that this is a Fed chair that wants to cut rates and is willing to look through some of the hot inflation data. But we do think the recent market fluctuation in pricing is quite reasonable, just given the strength in the economic data. But we think that the easing cycle is imminent. You even have the more hawkish tilted Mesa that's pointing to 3 cuts being reasonable this year. And so that should be a positive for risk assets. You have financial conditions that are much easier than they were last year, and they will get easier later this year. And at the same time, the U.S. economy is growing, and that's what's really important for stocks.
I got a lot of analyst notes overnight worried about Goldilocks' health and feeling like maybe she was on her deathbed or maybe she was really facing some pretty big challenges. It sounds like you're still embracing Goldilocks and seeing that as the most likely narrative. How do you push back against some of the gloom with respect to higher oil prices, inflationary inputs, and the idea that growth could potentially continue, but with some of these other aspects as well?
Yeah, of course, we're closely watching, the pickup in oil prices, just given the implications that it could have for inflation and, more importantly, consumer spending, which we know has sort of been a pillar of strength in the economy as well as for equity markets. But our attention is really shifting to the earnings season, which is upon us, we know, which will kick off next week. And we think that companies will be able to beat the relatively low expectations. I mean, we have, consensus looking for low single digits earnings growth. But if the early reporters, Lisa, are any indication, and historically they have been, we could see earnings growth come in at mid to high single digits. And we could see some upside from the more cyclical areas of the market. Because remember, you have Atlanta GDP now that's tracking at 2.5%, and you have recovery globally in PMIs. And then reality is it's higher for longer interest rate environment should be positive for financials too. And tech is still holding in there from an AI demand. And so we think that the ingredients are there, that even though we might see some, breather here and there, that ingredients are there for the bull market to continue in a healthy way.
We're about 23 minutes away from this non-farm payrolls report. How much are you expecting, or what could you see that would make you change your view on some level?
Well, I think if you see, of course, anything in the low 100s or below that, that will call into question the growth outlook, as we know that, maybe the Fed is too late and we're slowing down faster than expected. Or if you see something, are close to 300, then, of course, people get really concerned again about inflationary pressures. But we know historically what we've seen on Payroll Friday is that the market has knee-jerk reactions, but within a few days, it sort of sorts itself out. And we think that earnings is going to be that differentiator next week.
Nadia, is there anything that you potentially could see that could really shift the Fed in terms of not just no hikes, but potentially having a debate about another rate hike?
I think if you see, upward pressure on wages, we know that average hour earnings tends to be volatile and are prone to revision. So I wouldn't put too much weight on that. We know that the Fed's preferred gauge is ECI. So if we see a pickup in that number, that could give the Fed pause, and if we see continued upward pressure on oil prices, that could also be an issue. But we know that historically what you've seen, the sort of a rule of thumb for a $10 increase in oil prices, that tends to add about 40 or so basis points over a 3-month period for CPI. But the Fed tends to look through shocks and it's more focused on core. But that could give the Fed some pause if we see continued pressure upwards on the service sides, as well as any sort of a reacceleration on the good sides.
How hard is it going to be for the Fed, even if they want to look through the commodity resurgence we are seeing and the uptick in oil prices, even if they want to look through it, how difficult is it going to be for them to communicate around it, given the fact that we are expecting potentially more strikes and more geopolitical risk coming out of the Middle East?
I think it will be a challenge, and it's a needle that they will have to thread. But our core view in terms of the oil outlook we don't think that oil prices will be sustained for too long above these levels. I mean, our core view is for Brent to be at $86. And yes, with right now, it feels like about $5 or so are attributed to, geopolitical risk premium. But oil prices, we don't think it will be sustainable above $100 because reality is there is excess capacity right now, particularly coming from OPEC. And we would expect Saudi Arabia to step in and sort of balance the market and also to protect market share. We know what happened last year when oil prices spiked up. We did see a pickup in production from the U.S. side, and that ultimately led to oil prices moving back down lower. So we think that oil prices will probably come down back towards the $85, $86 range.
Nadia, can we just play a game just quickly and tighten up the time horizon to about 20 minutes? And forgive me for doing so. Stuart Kaiser of Citi just wrote in. He wants to handicap payrolls, non-farm payrolls. This is what he says. A negative read would be under 150K, given other subtle signs of weakness in labour data, or above 250, which would introduce inflation risk, but medium-term good growth is good. Nadia, how would you frame what is good news and what is bad news in about 20 minutes' time?
I would tend to agree with what Stuart has put forward in terms of sort of that knee-jerk reaction and thinking that bad news of under 100 would cause the market to fizzle a little bit and sell off a bit, and anything sort of closer to 300 would cause concerns about inflationary pressure. But again, like I said earlier, I think this will just be temporarily, and earnings over the next month or so are really going to determine the course of this bull market.
Nadia, wonderful to hear from you. It always is. It's going to catch up on Payrolls Friday. Nadia Lovell there of UBS. I love this survey from BMO. I want to share this with you. You might like this one, Lisa. 57% of survey respondents said they would buy if Treasuries fall after the release. This is payrolls in about 20 minutes. If Treasuries rally following the report, around 2/3 of investors said they'd do nothing. Only 19% would sell, compared to a 6-month average of 29%. What does that tell you about just the bias at the moment of fixed income investors?
That they believe that the Fed has their back, and they believe that rates are going to go lower, and that there is a natural inherent bullish tilt generally toward duration. And again, how many bumps do we need to see before that gets shaken? Because right now, that's been holding down the long end from being overly volatile past those triggers of 450, which we were hearing about from Priya.
If the bears capitulated in the equity market, I'm not sure the bulls have in Treasuries. Is that right?
I would guess that they've gotten more emboldened, because ultimately the whole narrative of around a Fed put has only become more concrete as time has gone on. And this idea has been even auctions don't seem to matter. Despite all of the big picture deficit issues, it never has really
Despite
taken
how
place.
much you try.
I've tried. And people say, keep trying. And then, you say.
Peter Cheer reckons it will start to matter.
Yeah, like
supply dynamics
in a year.
start to reassert themselves, maybe later this year, maybe the back half.
Well, it depends on whether we get a policy shift, whether the election could potentially be that shock.
Precisely. I think we spoke to Eric Cantor a little bit earlier this week, who was the former House Majority Leader about a decade or so ago down in Washington, D.C. And we've been asking this question for a while. At what point does Washington come up with a policy proposal that this market, fixed income, totally rejects? In a similar fashion, and this is what you've been talking about, to what we saw in the UK a couple of years back.
Neil Kashkari kind of leaned on that and said, well, the U.S. isn't going anywhere, and it really still has the fiscal dominance with the dollar, because that ultimately is the question, right? Can we face a Liz Truss moment? Other people say you start to get tariffs, you start to get tax cuts, you start to get the deficits that are already significant, and then you add to that potentially weaker growth. That could be a pretty toxic recipe that could lead to some rethinking.
Treasury yields right now up 2 basis points. Let's call it 4.33 on a US 10-year. Let's get you some stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Mortgage rates rose in the U.S., but just by slightly. Freddie Mac says the average rate on a 30-year fixed loan was 6.82%. That's up from 6.79% last week. Freddie Mac's chief economist weighing in, saying while incoming economic data indicate lower inflation, they do not expect rates will come down meaningfully in the near term. Tesla is heading back to court, and it's enlisting the help of Apple. The EV maker is aiming to prove the safety of its autopilot system after an Apple engineer was killed on his commute to work back in 2018. Tesla claims the driver was playing a video game on his phone when the crash occurred and aims to call an Apple engineering manager as a witness. The victim's lawyers say Apple is secretly helping Tesla blame the accident on distracted driving. And Elon Musk is giving away some blue check marks on X for free. Musk pledging to start handing out the feature to people who have more than 2,500 verified followers. Several users noticed this week that the blue check marks had suddenly reappeared on their profile. It marks a change of strategy for Musk, who has criticized the old Twitter's decision to hand out check marks to prominent accounts. That's your Bloomberg Brief. John?
Yahara, thank you. I'm proud to say I'm one of the chosen ones. It reappeared earlier this week.
Yeah, I've gotten some comments on that.
I saw a lot of people sort of the virtue signalling around it, saying, I didn't ask for this, who cares? I was kind of happy it came back.
Well, I mean,
weren't you?
Well, the whole idea is how many bots can it take before suddenly people realize, wait a second, the system isn't working? Because how many bots did you have? I mean, I would get complaints all the time.
Yeah, quite a few.
And then I would try to report them, and they'd never go away. There was one that was verified for a while.
But then Musk trying to make money off the check actually didn't work.
This reminds me of the Sneetches, Dr. Seuss, the people who got stars on their bellies, and then everybody wanted stars,
got a star on our
and
belly.
then everybody got them, and then people wanted the stars taken off. That's where we're at.
We've got a star on our belly. Is that
I
it?
think so. I think that's what it is.
Okay. Up next on the programme, I didn't know about that. The report, just around the corner.
This labor market is just amazing. We continue to see strong numbers. If we see a 213 or a 250 tomorrow, I wouldn't be surprised anywhere in between, which definitely demonstrates a very resilient labor market.
Tomorrow is 15 minutes away. The jobs report, just around the corner. Live from New York, 13 minutes away from the jobs report, looking for something in and around 200k based on our survey this morning. Equity futures on the S&P 500 a little firmer throughout Friday so far, up 1/3 of 1%. Under surveillance this morning, the jobs report just around the corner.
This labor market is just amazing. We continue to see strong numbers. If we see a 213 or a 250 tomorrow, I wouldn't be surprised anywhere in between, which definitely demonstrates a very resilient labor market. We're seeing a bit of rebalancing from the post-pandemic highs and lows. Employers are taking a more measured approach in terms of who they're hiring. We're not seeing layoffs spike either. And so people are staying put. Companies are holding on to their workers for the most part. And we're starting to see some evenness in terms of demand, some stabilization, I would call it.
It's the latest this morning. The March payrolls report due out in just a few minutes' time. The median estimate in Bloomberg survey calling for 214. Hourly average earnings coming in at 4.1%, and the unemployment rate down a basis point to about 3.8%. Former Fed Governor Randy Kroszner joins us now to discuss. Randy, can we just talk about what you're looking for at about 8:30 Eastern Time in 12 minutes, what you would be focused on if you were back on the FOMC?
Really focused on the wages. Because there's a lot of variation month to month, the number of jobs being created. But the key for thinking about firms' costs and where inflation is going to go are wages.
Do you think that the balance of risks still is pretty tilted toward potential weakness in the latter half of this year? Are you starting to rethink that, given how strong the data is?
Well, I do think that that we will start to see some weakening in the job market in the latter half of the year. As I've mentioned before, it's only about 6 months ago that real interest rates, that is the inflation-adjusted interest rate, became positive, so really became restrictive. We've only seen real wage growth over about the last 6 months. It used to be really great when you could hire people at 4% more, but sell stuff at 8% more. Now you're hiring them at 4% more, and you only get 2 or 3% more. That's not such a good trade, and so I think that'll see some softening later in the year.
What would you have to see in today's number that would make you rethink that would make you think that maybe there's a bit more strength than people have previously assumed?
Well, I think there is a fair amount of strength in the market, so I wouldn't want to say that it's not there. I think it's something that's going to come with those classic long and variable lags, and really, it's when real interest rates and real wage rates are starting to grow. That's when you might start to see a little weakness in the labor market, but typically that takes sort of 12 to 18 months to hit, and that's why it's more in the later part of the year.
Randy, it's the supply side of the story that's really dominated conversations on this programme over the last few months or so. We're trying to work out whether this easing in the labour market is actually down to the Federal Reserve or whether it's due to a very, very leaky southern border. Now, Randy, when you speak to economists on Wall Street right now, they start to lean more towards the latter and not the former. And I wonder what that means if you're setting monetary policy at the Federal Reserve, when you're acknowledging that some of these developments have nothing to do with what you're doing. How on earth do you set policy for the year ahead?
just shocking that something could happen without the Fed determining it. Sometimes when you're in those positions, you sometimes think that maybe you're a little more powerful than you actually are. And there are many of these factors, as you said, supply side factors that can be very important. Obviously, they're going to take that into account, and certainly that could account for some of the strength that we see in the labor market, that there are actually far more workers than we had originally estimated, and that would lead to stronger growth. So that would mean that they would probably hold tight for a while.
How difficult, then, is it to forecast a future labor market if, say, we get new immigration policies with potentially a new president?
Well, that certainly would be quite a while off, because even if there were a new president elected in the fall, those policies wouldn't start coming into effect until sometime next year. So it'd be a year from now. And I think the Fed is probably focused on this year at the moment rather than the next year. But it will take that into account in going forward, and they'll do some alternative simulations. They'll say, what if labor market policies are this? What if immigration policies are this? And then try to decide, well, what's most likely.
Do you think it raises questions about whether they truly are sufficiently restrictive?
So that's one of the key questions is, what is the long run neutral rate? And I think that it has gone up quite a bit from where it was before. We've seen a lot of different changes globally. We've seen aging of populations, particularly in China, and so less savings when people are older. And so when you're a University of Chicago economist, you kind of think in supply and demand. And if there's less supply of savings, that means all other things being equal, that interest rates are going to go up. So I think the long run interest rate is a little bit tighter, a little bit higher. And so that's why I think they're probably not going to push rates down quite as much ultimately as many market participants think.
You said a little bit higher. Bill Dudley said a lot higher. I'll share the quote from him. I'm sure you've seen the piece. Bill Dudley put this out on Bloomberg Opinion yesterday. The Fed is wrong about how low rates will go. This time around, the market has it right. The federal funds rate will probably stay a lot higher than what officials are projecting. Randy, can you give us a little bit more colour on that? What kind of numbers you'd be projecting?
So I think that's right. I think that the Fed is now thinking things are going to go a little bit more back to where they were just over the last few years. But I think they're more likely to go back to where they were kind of pre-global financial crisis. And so that would mean that the long rate is in the longer run, the rate is going to be closer in the sort of 3.5%. Used to be around 4%, rather than the around 3% that they're thinking now.
Randy, earlier last month, you talked about the idea that potentially you're not in the business of predicting markets, but stocks seem fairly priced to perfection from your point of view. They're even more priced to perfection, some people could argue now, given the fact that we've made new all-time highs several times since then. How much is this the Fed's issue? That, frankly, the Fed has fueled the rally that you think has caused price to perfection, given the fact that they basically have not batted away any of the financial conditions concerns and basically have said that the balance of risks for them seems to be to cut rates in the near future?
And so certainly we're seeing a lot of economic strength, I think more than the Fed had predicted, more than most economists had predicted. But you're starting to hear from them that they're going to hang tough for a while rather than start cutting rates quite as quickly as the markets had expected. And you've seen a pretty big shift towards where the Fed is. We've been on this program many times where I'd said, I think the markets are much too optimistic about all those rate cuts. And now the market is much closer and maybe even a little bit tighter than where the Fed is. That strikes me as reasonable. So I think at least for the piece that they have some impact on, the market expectations have moved closer to them.
Randy, this was great. It's always great to catch up with you, sir, on the first Friday of the month. On Payrolls Friday, the former Fed Governor, Randy Kroesner. The jobs report about 5 minutes away. Mike McKee with us around the table, ready to break that one down for you. Mike, what's the big focus for you this morning?
Well, this will be the headline number because basically Jay Powell has told us that's what they're looking at, the strength of the labor market. And if it starts to get weaker, then they would consider cutting sooner. That could be reflected in the unemployment rate, but we're seeing all these people come into the labor force, as you were just talking about, which affects the unemployment rate more than it affects the headline numbers.
Should we play a game? Would you rather be here or in Lake Como with Mohammed Al-Arian? Where'd you rather be?
If I were to be honest, I'd go to Lake Como because I could get on the internet and watch the Bloomberg numbers.
This is basically me lobbying to take us to the Ambracetti Forum
Is this
next
what it
year.
is?
Oh, sign me up.
Yeah, I mean, seriously.
Yeah, Mohammed is trying to basically say it's so rough for him because he's there with all of the cameras.
Oh,
pointing at
yes,
him.
super
we
rough.
We feel just terrible for you.
Sounds absolutely
Yep.
shocking. Coming up very shortly, Mohammed Al-Arian in Lake Como to break down the jobs report, and Jeff Rosenberg slumming it over at BlackRock HQ. Catch up with them in just a moment from New York City. This is Bloomberg. OK, this is it. We're about 23 seconds away from the jobs report. 214K is the estimate. The previous number is 275. The scores look like this in the equity market. Equity futures positive 0.4% on the S&P, up a similar amount on the Nasdaq. Big moves in bonds this week. Big range. Sub 420 1 minute, the next minute north of 440. Right now, 431.55. Yields higher by about a basis point. With the jobs report, here's Mike McKee. Good morning, Mike.
Good morning, and oops, we did it again. 303,000. The labor market is not falling down. We can tell you that. 275,000 is the last month's number before revision. We'll get an update on that for you. Change in private payrolls, 232,000. The unemployment rate does tick down to 3.8% as forecast. A lot of people watching the manufacturing payrolls number comes in flat. It was down 4,000 last month, so that's not as good as expected, but it's not as bad. And remember, we had that good ISM manufacturing number. Average hourly earnings come in as forecast, up 0.3 for the month and up 4.1% for the year. Now, it was 4.3% last month, and even though the monthly number was higher, base effects come into play there. Average weekly hours, 34.4. That's up 1, which suggests some additional strength in the economy. And the labor force participation rate is up to 62.7 from 62.5. The quick look at these headline numbers suggests that the economy is strong, the labor market is strong, and we're still seeing people coming into the labor force. I'll get some more detail for you.
Mike McKee, the equity market dazed and confused. And as we often say, in the immediate aftermath of a jobs report, the first move isn't always the right one, and we'll see if this one sticks. But here we are. Equity futures on the S&P 500 just about positive by 0.1%. In the bond market, yields, of course, higher on a 10-year by 6 basis points, getting back to about 437. The high of the year earlier this week was 442.74. We've been all over the place this week, but off the back of the jobs report, yields up. Dollar stronger. Switch up the board and get to the euro. The euro breaking down to about 108, just about holding on to that level. 108.10, we're negative by about 0.25%. Going through the numbers here, Lisa. 303K against an estimate of 214. Wage growth, even though jobs beat, comes in line with expectations. So the question you've got to ask as you work through this data, does it change the overall theory, the thesis at the Federal Reserve right now, that they don't have to worry about strength because it's not coming with big inflationary pushes higher?
That's exactly where my mind went when I saw how little, frankly, the bond market reacted to this. If you believe that this was really a headline-driven number, you'd expect a bigger sell-off in the bond market. You are seeing yields climb, but it's not an onward kind of climbing. If you look at some of the revisions, they were not revised downward so much last month in terms of just the headline numbers. This is a market that is creating an incredibly above-average number of jobs. I will just note this. Yesterday, the revisions for last month's wage increases were revised up. So when you start to put this together, on the margins, it's a robust labor market that does still have that inflationary pressure underneath.
I'll go through the headlines and Mike can give you the details. So we come in at 303,000, the estimate 214. If you're looking for unemployment, that came down to 3.8%, in line with expectations, down from 3.9. Wage growth month over month, the estimate was 0.3. We got 0.3. Mike, you've had a few minutes to chew over it. What are the details that jump out for you?
Well, the biggest detail that jumps out for me is the household survey employment number. It's been negative the past few months, and people were suggesting that was perhaps a reason why the story of immigrants coming into the labor force wasn't true. we had more people employed in the household survey than we do in the establishment survey. 498,000 added after 3 months in a row of negative prints. Unemployment down by 29,000. So we've got a reversal there, suggests maybe some noise in the earlier numbers. We have the labor force rising by 469,000. So people who are suggesting we are seeing maybe an immigration effect into the labor force could be right, because we do have a lot more people who were searching for jobs last month. In terms of where they got jobs, healthcare, 72,000 as always. And we are looking at government increasing by 71,000. Construction, 39,000. Some people thought we might have shot the entire arsenal last month with construction work, but it looks like they were able to find workers, and that means maybe housing is going up at a faster pace, and some of that infrastructure work is being done. Leisure and hospitality, 49,000, returning now this month to its pre-pandemic February 2020 level.
This is the 39th straight month of growth that we have seen in the United States, and it raises a question of how much and how long this can go on before growth itself can still remain something that is not a problem for a Federal Reserve. When you take a look at wage growth, does that offset the potential positive inflationary shock of these numbers? Is this enough to give the Fed a little bit of an easy feeling that even though we're getting such positive numbers, it isn't necessarily inflationary?
Well, it tells us that the narrative is not turning wrong, turning the other direction, that we are still seeing wage rates come down. But they are above where the Fed would like them to be. They think 3 to 3.5% is what's sustainable. We don't see inflationary pressure necessarily then in the wage numbers yet. Now the question is, the other things that are happening out there, like gasoline prices going up, are they going to push people to go back to the boss and say, hey, inflation, we need more money? Most people don't get raises in the middle of the year, and we've had the big contracts already at the unions, so this may keep the Fed on track to cut rates, but I don't think the strength of the numbers makes an argument to do that anytime soon.
Does this report mean that the Fed actually needs to be more focused on inflation? It can give itself more time for inflation to come down because the jobs market is not deteriorating.
Well, that's the argument they've been making, that they have time, they don't have to jump into this because the economy is strong and the labor market is the reflection of that. Companies wouldn't be hiring if they thought we were going into recession. So if we're not going into recession, then the Fed doesn't need to cut rates right now.
Later and fewer is different to hiking again. And at the moment, Bramo, you look at data like this and you start to think about later, maybe later in the summer, perhaps even September, and fewer, maybe not 3, perhaps 2. But we're certainly not having a conversation about hiking interest rates because wage growth is running away off the back of that jobs growth.
Which is the one thing that people say is keeping some sort of floor under this market. What we do see in some swaps trading right now is the idea of a full rate cut being priced in now in September rather than July. So later and fewer seems to be where the market is headed.
But later, next Tuesday, CPI gets even more important now because the Fed is going to be looking to see if inflation is coming down or if we're starting to see a rebound because of this strong economy.
Things could change quickly. We've been whipsawed 5 different ways already this week across 5 different days. If you are just joining us, the payrolls report comes in at 303,000. It's a big upside surprise. Again, 214 was the estimate. If you work your way through the report, the unemployment rate comes down to 3.8%, down from 3.9. Average hourly earnings month over month, 0.3. in line with the estimate of 0.3. The equity price action looks like this. We're positive 1/3% on the S&P. We're up by 0.4% on the NASDAQ. The bond market price action, if you switch at the board, looks a little something like this. Yields up by 7 basis points on a 10-year, getting closer to 440 again after breaking through that level earlier on this week. The 2-year yield higher by 4 or 5 basis points, getting very close to 470. And I'll give you a snapshot of foreign exchange off the back of this. I'll make it simple. Dollar stronger against absolutely everything in G10. Euro dollar at the moment, 108.15. To break down and react to some of this, I'm pleased to say that joining us from BlackRock is Jeff Rosenberg, and joining us alongside him is Mohammed Al-Arian. Mohammed, you've had a bit of time to chew over this one. What's your big takeaway?
John, it is a jobs report that confirms U.S. economic exceptionalism. You're having strong supply side, strong demand side. So if you look at the economy continues to benefit from the favorable supply shock. If you look at the Fed, that's not going to change much what the Fed is thinking. And believe me, the administration will be celebrating this report. So overall, a very strong report that just confirms that the U.S. is an economic exception among the advanced economies.
Jeff Rosenberg, do you believe this labour market report is a report this Federal Reserve can fully embrace?
Well, it can fully embrace it, but it is a little bit challenging around the timing issue. I think the key thing in this report we haven't talked about is labor force participation and its impact offsetting some of the wage concerns. And I think that's kind of the good news. Lisa, you asked why a little bit of a more modest reaction out of the bond market for such a headline beat. And I think that's it, is that you're seeing kind of it's a strong labor market, but the wage picture isn't, at least in terms of what you see in the print today, ticking up beyond expectations, so that relieves a bit of fears. And then you look at that labor force participation rate ticking up. That's good news for the wage front.
Given all of that, though, Mohammed, why cut? I mean, I go back to what Neel Kashkari was saying, given the fact that the U.S. labor market seems to be doing just great. What is the onus on the Federal Reserve to ease policy that doesn't seem like it's hampering this economy?
It's because policy acts with a lag. These favorable supply shocks are not going to last forever. And there are signs of weakness elsewhere. So you've got to navigate this. You've heard me say this over and over again. The mistake the Fed will make, if it makes a mistake, is being overly data dependent, becoming a play-by-play commentator, and not looking through various things. So you've got to look forward. Yes, we're having a wonderful supply shock. Has a lot to do with immigration, and that's why, as Jeff rightly says, the wage numbers are restrained. They're still not low enough, but they're restrained. But if you go forward 6, 12 months, you've got to be conscious that a lot of what has powered the U.S. so far, including excess savings, is going away.
Jeff, what's your take on that? The argument that Neel Kashkari made yesterday of the Minneapolis Fed, why cut rates if you have robust economic data and a labor market that seems to be chugging along, especially if you do have commodities inflation that people can afford to keep paying because they are still employed?
Yeah, I think it's about really the debate between what I call, and the market calls, maintenance cuts to maintain the degree of restrictiveness, what Mohammed was talking about, that you don't want the lag in policy to eventually become too restrictive by holding real interest rates at these high, at least relative to historical levels, and the threat that may down the road lead to more tightening than what you would otherwise want. But that's different than saying we need to calibrate the cuts to a slowdown. And I think what Neel Kashkari is talking about is really pricing out really what already happened in the bond market. We came into the year pricing in 7 cuts. We're now 3, maybe pushing down somewhere between 2 and 3. I still think that's right in the sense of you want to have that insurance. And this is a Fed that is very much wedded to trying to secure the gains of the soft landing.
Jeff, how dependable do you think this economic data is? That's a subject we've revisited a few times over the last few months. How dependable do you think it is?
Well, it's really interesting, the backdrop to what's going on in the movement to reprice away from 7 cuts to 3 cuts is that you had this debate between 2 big sources of data, both for growth and for the labor market. On the growth side, it was the debate between GDP and GDI. GDI had been lagging the strength that was shown up in GDP. That gave a lot of people in the market a lot of evidence that, hey, this economy is a lot weaker than we thought. What did we learn most recently? GDI rose to GDP and validated the stronger story. Similarly, on the labor market, you had the gap between the household and the establishment survey. And a lot of people saying, oh, the establishment survey, the headlines is overstated. Look at the household weakness. Well, now what we're seeing, and that's the latest theme, is no, it's the immigration that's not being captured. The labor market is much stronger. So in both cases, with respect to kind of alternative data, you had a debate. That debate is pushing more on the settle of the side of, no, this is actually a stronger economy than we thought. And that's what's validating this kind of move to push back from 7 cuts to 3 or less cuts.
It's the supply side story I think we all struggle with, Mohammed. When you really start to think about it, what the Federal Reserve is telling you is that basically don't worry about strong data. like payrolls growth of 303,000, because it's not coming along with stronger wage growth off the back of that, because we're embracing this big supply side phenomenon. At the same time, Mohammed, they're also pointing to the labour market as evidence they are sufficiently restrictive. And I struggle to reconcile the two things. Can you reconcile the two things? How can you use something as evidence of being sufficiently restrictive, but also acknowledge that the majority of it is supply driven?
Because they're trying to have maximum optionality, John. And that's what they want. It's the same thing that led Chair Powell at Stanford to say, on the one hand, the inflation story has not changed after the hotter than expected print in January, February. But on the other hand, we need more evidence that actually the inflation story is what we think the inflation story is. Look, I would be doing the same thing. They are trying to maintain optionality, and they are having competing claims. Also, don't forget that the positive domestic supply side story is countered by a very negative international supply side story. So they've also got to balance these two things out.
Mohammed, I'm struck by what you said a while back, where you were saying that this is going to be a Federal Reserve that ultimately will probably accept a 2-point-something inflation rate. If you take a look at the preliminary bond market action after this report, and understanding that the first reaction isn't always the right one, this bigger sell-off is in the long end. This is basically a confirmation that this market believes that the Fed will make good on its promise, essentially, that it will cut rates at some point this year, while allowing inflation and growth to continue to run at a somewhat hotter speed. At what point does that become concerning to you, Mohammed?
It only becomes concerning, Lisa, if it de-anchors inflation expectations. I think there is a slow but sure migration in markets, even among policy observers, and certainly among quite a few economists, to the view that, yes, we're not going to get to 2%, we're going to get to above 2, closer to 3, and that's going to be stable. And the policy mistake would be to go after 2% inflation too quickly. You heard Bill Dudley yesterday, and I agree with him, saying, think more about a 2.5% inflation rate on average. You've heard about how asymmetrical the Fed is to when it misses on one side or the other side on inflation. Look, we're going to settle into an inflation world that's higher than 2%, and I suspect that is stable. The risk is to try to force it down when the economy can sustain a slightly higher one, because you then undermine economic well-being.
Which raises this question, Jeff, about at what point the bond market will adequately price in a higher inflation future. John was talking about the BMO survey and how there essentially is an inherent bias among bond investors to buy duration, to buy longer-term bonds on sell-offs, just simply because they believe the Fed will achieve their goal and will continue to set rates at a lower rate. How much can you get behind that, and how much do you push back and say, no, there is something else afoot in the long end of the Treasury curve that makes you not like them?
Yeah, I really think that with rates at this level that we're going to shift away from that view that the long end is the best place for the hedge. It used to be a long time ago that flight to quality meant that the curve would steepen, that the best performance in terms of yield change would be in the short end. And I think that's the environment that we're in. If you go back a year ago during SVB, that was exactly what you saw happen in the curve. The best performance in terms of yield change for your hedges, granted that you need to have the right notional amount to make this a fair comparison, happened in the front end. The strongest negative stock bond correlation by bond maturity was in the 2-year. The weakest was in the 30-year. And I think that's the environment that we're in. And as we start to see more evidence of that, that's going to help, if you will, to bring back in some term premium. Because part of the flattening of the term premium was the pinning of zero interest rates in the front end, which meant that a flight to quality had to be in the back end because you didn't have the room to run in the front end. With the level of front end inversion that we have today, you go back to that earlier kind of textbook that flight to quality is in the front end and a steepener. And that I think is going to help to bring back a higher level of term premium, more consistent with the inflation narrative we just heard from Mohammed.
Interesting. Jeff, before you go, I want to talk about stocks with you as well. Just to put a bow on it, is this a stock market friendly jobs report this morning?
I think it's okay. I think when you look at the stock market, what we've seen this year is a lot less dependence on the denominator, right? It's last year was all about inflation expectations, the 5-year driving headline equities. You've seen a lot less of that. So I think it's less of an issue because so much more of what we've seen in stock market domination is really coming out of the numerator. It's coming out of the earnings, the power of secular growers, really overwhelming the much smaller concerns in terms of the degree of change that we're seeing in terms of the denominator.
Jeff, this was great. I know you've got to run because you're at work today. We're not all at Lake Como. Jeff Rosenberg of BlackRock has got to run. Mohammed's going to stick with us, I'm pleased to say. If you are just joining us, we've got the brilliant Mohammed El-Erin of Queen's College, Cambridge, alongside us to break down this jobs report. Jobs report, about 20 minutes old now. These are the numbers for you. 303,000 against an estimate of 214. 3.8% was the unemployment rate. The number we were looking for was 3.8. That was down from 3.9. Wage growth, 0.3%, in line with the estimate of 0.3%. So here's the reaction to it. Equity's just about positive, still. A third of 1% higher on the S&P and on the Nasdaq as well. In the bond market, yields do bleed higher by 7 basis points or so to about 438 on a 10-year. On a 2-year maturity, yields are higher by 6 basis points and back through 470. When you get higher yields, typically you think about a stronger dollar. It's what you've got against everything in G10 today. The euro is weaker. The dollar is stronger against the yen, the euro, sterling, the Aussie, you name it. Basically, right now, the dollar's stronger against it. We're breaking down to about 108 on euro dollar. Mike McKee with us around the table to break down some of this jobs report. Mike McKee, you've had about 20 minutes to pore over this one. Anything else jumping out to you about what's behind some of this?
Well, obviously, the big rise in the labor force is what's going to intrigue a lot of people because of this debate over whether undocumented workers and immigrants in general are propping up the labor force and helping it grow. We don't have exact numbers on, they break it down by foreign-born and native-born, but the foreign-born slipped a little, the native-born rose a little bit, but it doesn't really tell us the answer to that question. Other interesting thing is the government employment continues to rise significantly, up 72,000. In this case, the biggest part of it was in local government, excluding education. We'd been seeing big gains in education, but now it's local government, not education. It's not the federal government, so you can leave that part out of the politics. Only 9,000 jobs created there. And looks like... yeah, none of those were in the Postal Service. Oh, they were in the Postal Service. 9,000 in the Postal Service. Beyond that, it's not a thing.
As I've mentioned a few times, at the Unprecedented Forum, Mohammed El-Erin of Queen's College, Cambridge, alongside us. Mohammed, let's get into a piece you wrote earlier this week on American exceptionalism for Bloomberg Opinion. You've mentioned that a few times. What you didn't mention was something you pointed to in the piece and really, really highlighted, and it was the difference between what's happening in Germany versus what's happening in the US bond market. Mohammed, how important is that spread between the two at the moment?
It's important, and it's the reason why you're seeing the dollar strengthen. Look, John, it's gone up to about 200 basis points. If you look at the last 3 years, the low was 97 basis points, and it reflects two things. One is that U.S. economic growth has and will continue to outpace Germany's and the rest of Europe. And the second thing is that inflation will come down in Europe faster than it will in the U.S., and you may well end up with more ECB cuts than the Fed, even though the ECB didn't hike as much as the Fed. And I think the markets are starting to incorporate these two things, and that single differential captures really well these different factors.
Yeah, I'm struck by the idea that the U.S. immigration story is so different from other areas around the world that are facing real demographic problems, like the Euro region. From that point of view, when does the euro become a problem in terms of a weakness and an importing inflation issue? Or is that almost a welcome development so that the European region can compete against American exceptionalism?
It would be at the margin welcomed. I think more concerning is what's been happening to oil prices, and that's something we don't talk enough about. But when you see Brent in the 90s, that is going to have a stagflationary impact on Europe. You know, it's good to come and visit and participate in these European conferences, and the one here at Abramowicz is excellent because you hear a completely different narrative about the economy, about what's happening to the supply side, and you realize how exceptional the U.S. is right now. And this divergence is not just going to stay, it's going to increase over time. And that's something important when people want to rush to fade the U.S. in terms of equity allocations elsewhere. Just look at the underlying stories. They are very, very different, Lisa.
Well, just to put together some of the things that you said, given the fact that we are seeing oil prices rally, are you saying that that could be a stagflationary shock for the European region and that, frankly, it could only widen the divide between Europe and the U.S. that also stands to benefit on the other side from higher oil prices?
Yes. I mean, I wouldn't say shock as much as I would say stagflationary headwind. And it makes a transition that Europe needs to make, which is the US is making, from an old, exhausted growth model that depended on exports to China, that depended on all sorts of things that are no longer happening, to a new growth model that stresses things like generative AI, life sciences, sustainable energy. It makes that transition for Europe even harder. So yes, it is an important factor to keep in mind because Europe doesn't need additional headwinds right now.
Mohammed, we'd love a final thought on what we got this morning and what it means for Fed policy. This from Torsten Slock of Apollo. He said, the source of this strength is easy financial conditions. We are sticking to our view that the Fed will not cut interest rates this year. Mohammed, what's your reaction to that? And do you agree?
So I understand where he's coming from. He even had a non-voting member of the FOMC yesterday roll market by a statement. I think that if this Fed is continuously overly data dependent, then maybe we don't get cuts. But I'm hoping that they will see through the backward-looking data and look forward. And I think we will end up with 2 cuts this year. It may not start as early as a lot of people thought initially, but I do think we will get 2 cuts.
Mohammed, this was great. Thanks for making time for us today. We appreciate it, as you often do on Payrolls Friday. Mohammed Al-Erin of Queen's College, Cambridge, working through another upside surprise, Lisa, on the jobs report.
You mentioned Torsten Slock, the headline of his piece, the economy is reaccelerating. And that, I think, is going to be one discussion point for a lot of people. How much acceleration is going to be a problem for the Fed, or is it just simply welcome for one that really is prioritizing inflation coming down, even a little bit being the most important aspect?
I'd like to go up to Mike's point earlier where he said this is going to be welcome in the White House. But you have to think, in December, Biden said we were in a sweet spot. The Fed shouldn't be hiking rates. Potentially they're going to cut. Is good news actually bad news for them? Because it means going to an election year, they might not get a rate cut.
You know what I haven't said once all morning? Let's get you to the weekend.
Thank you.
Let's get you to the weekend. There you go. 35 minutes away from the opening bell. Equity futures positive by 0.4%. It's another rock-solid jobs report, a big upside surprise. The source of this strength, we could debate it all day. It's not coming with runaway inflation. What does that mean for this market? Stocks are higher. The bond market's hanging in there. Yields approaching the highs of the year, close to 440 again on a US 10-year. To debate it on Monday morning, Jeff Yu of BNY Mellon, Lara Rain of FS Investments, Jimmy Chang of the Rockefeller Global Family Office, and the brilliant Subhadra Rajappa of SocGen. To all of you out there, have a wonderful weekend. We'll see you Monday from New York City. This was Bloomberg Surveillance.